So you'll bring up Dan Basse. Dan, would you come up and just look everything over here for the... Please come in and take a seat. We're ready to begin the morning general session of the 31st A-State Agribusiness Conference, the 2025 edition. I'm Bert Greenwalt, the conference director, coordinator, and I'll be your moderator today. Some of you have been here many years, each year. This is our, as I said, the 31st edition. We began in 1995 with the goal of providing information important to the agricultural economy here in our region, both for producers, business people, and also for the education of our students who are here today from the A-State College of Agriculture. This program continues that tradition, and I'm very pleased that we have an outstanding group of speakers with us today to share timely information about the agricultural economy. So we'll begin this morning with a review of global markets. You can see the title screen. Our first speaker, Dan Basse, is the founder and president of AgResource Company. And Dan was first with us a couple of years ago. He did such a great job. We had great reaction to his presentation, and he agreed to come back this year. AgResource is a firm based in Chicago that provides information to farmers, grain elevators, food companies, and traders around the world. Dan previously worked with Professional Farmers of America, Brock Associates, Richard Brock, and GNP Commodities. He is from a farm, dairy and grain farm in Waukesha, Wisconsin, and earned his master's in agricultural economics from the University of Madison. Dan was last here in 2023, Dan, and lots happened since then. Oh my God. And a lot happening this week. So Dan's been making the news. He's been traveling around the country speaking and getting a lot of attention everywhere he goes. Dan, thank you so much for joining us today.
Thank you, Bert, and I appreciate to be with you. I don't think Arkansas knows what a gem they have in Bert. I mean, I told Bert, I've been doing this now for 45 years, and I said, Bert, I'm getting close to retiring and, slowing down. He goes, no, you need to do this, you need to do this. And so he persisted. There's no one I respect more than Bert, and because of him, you have a gem in terms of going forward, in terms of leadership. We want to talk about the agricultural markets, and I hate doing these kind of speeches when there's so much uncertainty, and there's a lot of uncertainty in the world today. Think about it for one moment. If you were to give me a one word that describes what's going on in Washington today, what would that word be? Chaos. Anybody else? Chaotic. There you go. The word that comes to my mind is called demolition. I think Trump is demoing the U.S. government. I think he's going to build it up from the rafters. I think we're going to the basement. And I think we're going to see whatever's there. We haven't cleaned the closet for almost 249 years. We're going to clean the closet, and we're going to see what we can build from there. So my word is demolition. I think anything you think about as safe or fair is going to be thrown out the window. So as this goes on, think about USDA, 92,000 employees. Do they end up with 50 or 40 or all happen? What programs are they going to find? There's going to be lots and lots of changes going forward. So we've got Trump going there. We've got world dynamics that are changing rapidly. So I just kind of want to hop in here. When I look at where the world agricultural landscape is, I've got that fence there, and the fence is there for a purpose. I believe on one side of the fence may be grain farmers. On the other side of the fence may be livestock farmers and the dairy industry. And so it depends on what side of the fence you're on in terms of where your margins sit and what the opportunity is. I am very bullish of cattle. I know this isn't a cattle conference, but I'm very bullish of cattle, somewhat bullish of pork and poultry, excluding avian flu, and the dairy industry is come along. So the species side of the equation in agriculture, in American agriculture, is very strong. I worry about grain markets, and we'll talk about that going forward. First of all, I want to level set you. I'm a guy that has offices in Chicago, Brasilia, and Geneva, Switzerland, and so I like to talk about the world grain markets. Grain markets are world-centric now, and so when I first started in this business 45 years ago, to me it made sense to get the U.S. balance sheets right and get the cash markets right, but today we need to get the world markets right. And when you look at the world markets today, you can see the wheat markets kind of maybe trending upwards. So if you were to ask me the most bullish grain today, and I would tell you that it's wheat. You got followed by corn. The corn markets come along because of a weather problem in the Black Sea and some problems in terms of planting the winter crop down in Brazil. So it's coming along. And again, pick out your favorite destination, whether it's U.S. Gulf, Brazil, Argentina, Black Sea, they're all there. If you ask me the most bearish market today, it's soybeans. And so when I put it all together, this kind of gives you a litany of where we see things today, and it's a level set in terms of where we need to go forward. Also, when we think about the world of grain, I think that you all need to stack the world production and consumption on top of themselves. This is something I've done throughout my career. So I take the 4 pillars of the food industry. I call them barley, corn, soybeans, and wheat. I put the production on one side, I put the demand on the other, and you can see last year we lost about 17 million metric tons of grain. In other words, we didn't produce enough to meet consumption. And so to me, that gave us a flavor after we got through with the U.S. harvest that there was going to be a bounce in the grain markets. Again, South American weather in the last 4 to 5 weeks has helped us out, but that's why we're at $5 corn. That's why we're at $10.75 beans last week, and that gives you a flavor of where we are today. I also want to level set you to say, if you look at the world exportable supplies of grain, stocks to use ratio in terms of the major exporters, this is what drives global grain prices. When we do our work at AgResource, this is one of the first things we look, and your eyes should quickly go to corn. Notice that the world stocks-to-use ratio of the major exporters on corn is historically low, followed by wheat, and then you see soybeans and soy meal, which is kind of spiking upwards. So when you think about global grain markets, it is corn and wheat, the grains that have the upside potential to some degree, but I am not as bullish of soybeans for reasons we'll talk about going forward. Now, every month, the CME and Purdue University get together and they do a survey of you farmers. What do you think about the world? How optimistic are you? What do you think about what's happening? Notice that big run-up in your optimism that all occurred in the last couple of months. Now, as I go around and I speak to various audiences in farm community, I get the same response. Why did you get the big response there? Why are you so much more bullish today than before? If you look at the survey data, it's one reason: President Trump. A lot of you, of course, voted Republican. Trump is in the White House. You believe that your futures are now better because of him, though if you look into 5-year outlook, here, 5 years from now, you're not as optimistic. But at least nearby, you're more optimistic than you were before. That's a big jump. That's the largest improvement in farm sentiment for the outcoming outlook that we've seen looking back towards when corn was at $7 and soybeans were at $14. And why? It's all because of this, I believe. Last time President Trump in January of 2020 signed this agreement called the Phase 1 agreement with China. Every year China was to buy 35 and see how big our checks are going to be. And I think this is forthcoming. So when you think about why there's farm optimism, I believe that these 2 ingredients really play into that optimism going forward. Whether or not we get a Phase 1 agreement, I'm doubtful. I just don't see that happening. Of course, the administration is talking about Trump trying to having to go back and make good on the last one, which is $85 billion. So for China to even get negotiations with a new Phase 1 agreement, they got to come to the table and buy $85 billion of U.S. goods, not ag goods, but U.S. goods. And so that's all important as we think about it going forward. When you look at farm income peaked back in 2016 and dropped for 4 years. This year we're down 2 years, we dropped $40 billion or 22%, But then you see that big increase here that's projected. This just came out on February 6th from USDA. Why the increase? Well, this is the $31 billion that, of course, was appropriated to you all. So let's call it $40 an acre for corn, maybe $37 for soybeans from the last administration that they of course. So that is why farm income is rising. If you look at their breakdowns for corn, soybeans, wheat, or cotton, notice that all of their forecasts are lower for the year ahead. So that bump in farm income is, again, what we call give-outs. I can't call it Trump bucks, maybe we'll call it Biden help, but that is why we saw the increase. Now let me also go back to last year to have you have an idea about farm income and how this all happened. If you look at last year and you look at crop receipts from the farm, notice that it was down $46 billion because the markets fell. All cash receipts were down, but there was an offset. Look at that offset of $19.9 billion. That was offset because of better yields. So you farmers last year had, of course, a bump in yield, but of course the market declined. That left you down $25 billion on the year. As I said before, if you're on the other side of that fence and you're in the livestock industry, a record year, $21 billion from the livestock industry, leaving your net at $4 billion. So holistically for the ag economy, it wasn't all that bad unless you're just a row crop farmer and you didn't do very well in your marketing, and then you're struggling going forward. But again, the money from that came out from Congress in late 2024, $31 billion, is going to help all of that. When you think about direct payments or what's coming to you forthcoming, this is a graphic giving you whether it's a market facilitation program or conservation or pandemic going backwards some time. You can see how those payments have been spread out going back to 2004. Last year was the lowest direct payments since 1982. So nearby, you haven't been running to your mailbox because there's not been anything in it. We didn't get any checks. But as you think about the forward, look at that 20 to 21 time frame. I think we're going to move back to more of that, where, again, we as farmers don't want to farm for, let's call it facilitation payments or something like that. But I also don't know many farmers that are going to turn that check away. I mean, most of you cash them when they come in your box. So as I think about it, expect that as we go through this rough spot, that you're going to see more help from the U.S. government in a direct fashion. Now, one of the hard things we always have as farmers is trying to understand best how we can take people's hands out of our pockets, right? Commodity prices were good from 2021 to 2023, or the end of 23. And when they were good, everybody put their hand in their pocket, whether it was the machinery seller or the fertilizer salesman or the seed salesman. I've tried to stack everything else out here so you can see relative costs. This is USDA data, breakout for the upcoming crop of corn. Now, as we do our data, there's one thing that's really coming up that's hard to get your hands around in terms of a farmer. There's really two things. Number one is insurance. How many here have seen their insurance costs just soar? Every client I have, insurance is going up through the roof. And there seems little we can do about it other than just argue and cry and nothing changes. The other thing that's been really difficult to handle in terms of farm costs have been repairs. I mean, John Deere starts charging me as soon as he gets that pickup truck and drives an hour away, and then he doesn't do it to the way back. I saw clients this year that maybe thought they had made $60,000, $70,000, and when we got the repair bills all added in, that ended up being a negative $50,000 or $60,000. Repairs are really getting into the cost. So this includes some of that, but I'm telling you that in a broad sense, I don't think USDA data is getting deep enough into insurance and into repairs. Nonetheless, as you look at this, you can see the big breakout here is fertilizer, and then you can, of course, notice in your chart to your left that as you look at things, it's really the cost of producing a crop of corn this year will go up 2 to 3%. So again, how do you take the hands out of the pockets on the farm in terms of what's happening? This is going to be very difficult for the farmer. If grain prices stay low, how do you manage costs and how does this change going forward? I don't have great visibility on it because I think a lot of these costs are going to stay high. In particular, if there's tariffs on things like potash and other things going forward, it's going to be very problematic for the future. At AgResource, we talk a lot about demand drivers for you. In agriculture, everybody needs a demand driver. What is a demand driver? Well, this was ethanol in China coming to the world ag market. And in this graphic here, you can see that from 2006 up until about 2013, when the ethanol mandate or the overall peak of supply occurred, we had great years in terms of farm profitability. You can see that average farmer made somewhere between $200 and $300 an acre in some years. These were really good times for American agriculture. Then we kind of had a mini good time, if you will. We got back from COVID. We have, of course, had supply chain breakdown. We had inflation. We had things happening. And again, a very positive time. Notice what you get in between. So when I talk to you, I look at demand drivers saying, hey, we need to have more demand drivers. Today, I thought maybe it was renewable diesel, but that doesn't appear to be happening in terms of climate smart. So today I'm lacking a demand driver for the farm community, which means I'm looking for that next uplift in terms of new export demand, of new biofuel demand, or something that will take us to higher price levels and profitability. With that in mind, you can look at this graphic here. I've highlighted and stacked corn, soybeans, and wheat on top of themselves in the United States. Barley, not a big includer in this, and you can see that we are looking for stocks to grow with normal weather in the 25-26 crop year. So this is a stocks accumulating kind of time frame, which again, if you're a farmer, what I would tell you about is these are time frames that we need to be looking at, selling rallies, and of course, making good, solid decisions in terms of your margins and profitability. So I get a lot of questions, why is everything so bearish for American agriculture? What's happening? What is the one ingredient that's really changed here that is giving us problems as an industry going forward? And so I took this graphic with the permission of the Senate Ag Committee and said, this is a real problem that we have today. Trade. You know, American agriculture always has been a contributor to the benefit of American trade. And you can see all the way back to the 1960s, we on that dark blue line have always been positive. Then in the last 3 years here, we've seen negative trade margins. We started off in 2023 at minus 17, last year minus 30.5, and this year it's estimated at 42.5. And so trade has not been something that the Biden administration focused on, and it's something now that we're starting to see real laggards. And again, remember, you as American farmers are also in this bad position of being the world's high-cost producer. High-cost producer. So it used to be that, going back 60s or 70s, that you had the logistical advantages and a lot of other things, and that's now been lost. Now, when I talk about trade, I'll break it out a little bit here, but you can see in the top 10 agricultural commodity exports by value, let's look at these three because overall they account for $50 billion of ag trade, or 47%. So when you think about ag trade, okay, if you're in the cotton business, yeah, $6 billion is important, or maybe wheat at 6.1, but it really comes down to soybeans, corn, and soy products. Those are the three commodities that really make up the difference longer term, and so that's what I want you to focus on. Also be aware of it right here, total ag export value. 2 weeks ago, President Trump put tariff threats on 3 countries, Canada, Mexico, and China. Added together, those 3 countries come up to 77 billion of the 106 billion. So those kind of things worry me. As an economist, this gets into my head and causes issues going forward. The other thing I want to talk to you about, which I think is really important, and it's a developing fundamental that we talk a lot about in agriculture. In fact, this was a big topic that ended up being a subject of the World Economic Forum in Davos, Switzerland. We call it a developing duopoly. Now, we in America, since World War II, the last 70-some years, have been at the pinnacle of capitalism. We were the center of it in the United States. Whatever we did, direct everything around the world. And so for a lot of businesses, the only thing you had to do is you had a new product, you decided where you could produce it the cheapest in the world, and then you sold it. That was capitalism from American perspective. Today, this is all changing. And we're calling it the new duopoly of world economic influence. You'll see President Trump tweeting often about the BRIC countries, things that he didn't tweet about in his first administration. Why is he doing that? Well, obviously, if I add up the GDP levels of the BRIC countries, which is Brazil, Russia, India, China, and South Africa, it now accounts for 32% of global GDP. They are bigger than we in G7, which includes, Europe and a lot of the United States. We're 30% of GDP. We're massive government deficits, and yes, the BRICS are stockpiling gold, which is one of the reasons the gold market's been doing so well. And because of the Russian-Ukrainian war, the dollar has become a weapon of foreign policy. So instead of the last 70 years in which the United States has been at the center, I believe there's going to be two channels developing globally that we need to be aware of: the BRIC countries and the United States. And trade and what's happening with tariffs is only going to accelerate this process, depending upon how it all comes out. Stay with me on this, because I think it's important to understand. If there's one thing I would leave you with you today, it would be this. If I go back to 2000 and I go back to 2020, notice how China's Belt and Road program has really changed. It used to be as a few countries in Southeast Asia and Africa and the Belt and Road, but I say now, who are you going to call? So as the world looks at tariffs from the United States, we already have this Belt and Road initiative here, taking about $2.8 trillion between China and the other country, now estimating that 5.1 billion people with $41 trillion in combined GDP. China has been very smart in using its Belt and Road program to have a free trade zone, including all the way to Panama. Trump's argument with the Panama Canal is he really doesn't want to take it over. He just doesn't want Panama to be a Belt and Road initiative country where free trade is happening away from the United States. I got ensnarled in this tariff thing with China because I have some clients in China. And so if they pay me in the United States, I have to pay the 10% tariff. So this is how this all works. But I asked those clients in China, I said, send me something that visually would help the audience better understand what's happening with the world. And this was last summer. And this went on for a couple of months. And they sent me this map back. And I scratched my head for about 2 weeks and said, what are they showing me here with this overall map? What's going on? They said, Dan, this is how you need to think about the new world. I want you to take and draw a circle from Antarctica looking northward. And this is how we, China, and the rest of the world think about things as it's sitting today. And so we are that appendage up there called North America. We're dangling. We're not part of that Belt and Road initiative. So as the Chinese and others are to say today that China's boom is over. The Chinese are not the country that they once were. And when I look at Chinese food consumption, milk, powder, beef, chicken, pork, palm oil, soy oil, or wheat, notice that they're stagnating. And when I look at Chinese GDP rates and using the IMF forecast of 4.1, the World Bank's at 4.5, they're looking at GDP rates that are far below where we've been for the past 20 years. And so if I look at China, China economically is no longer the powerhouse that it wants. But this is why they had the vision to do Belt and Road, because including themselves within those free trade zones is now very important and gives them latitude in terms of what's coming up with tariffs against the Trump administration. And for AgResource and myself, and looking at China to see if there's any change in their economy, has been Chinese weekly raw milk prices, kind of a luxury, and also the beef market. And as you look at either beef or milk, notice that both have been turning down. Now, China's struggling mightily with real estate. They overcapacitate. You see all the stories about roads to nowhere, apartments that are unfilled. Now the government, rather than paying its debt back to countries, is giving them real estate. All of this is problematic, and how China will get rid of this real estate problem is going to be difficult to understand. But as we walk and we start to understand if consumer demand is coming back, I'm watching Chinese raw milk and beef prices to really understand when the consumer comes. As of today, after the Lunar New Year, still no evidence that that is indeed the case. And Chinese farmers, for the first time looking backwards to 2016, are also losing money in corn. So as you look at China and you stack up inputs, material, labor, and land costs, maybe a little difficult to see there on the screen, but you can see that the Chinese farmer is also seeing less than what he would receive in the marketplace. So I guess my point being, as we went to the end of December and you see the slide in Chinese corn prices there, is China going to import a lot of grain at the same time their farmers are losing money? And my response is probably not. And this is why USDA has been cutting their export forecasts almost every month and did again yesterday. Moreover, I've been trying to understand what GMO is going to mean for China. Of course, the Chinese last year approved many GM products that they will be giving seed to farmers this spring to plant. Now, I've been trying to understand, what kind of yield bump does that give China? Is it 5? Is it 10? Is it 15? 10 or 15 is where I'm kind of lighting upon, but again, I think we need to watch this because here's an advertisement to some of the Chinese farmers. China approves GM wheat, but that's not GM wheat. So I wonder a lot about China. But I do believe with time, GM crops will help them stabilize yield or make improvements. It's something we need to consider about. China is on a message here of self-sufficiency, and just in the last couple of weeks here, they bought nearly 1 million tons of Argentinian soybeans. China never buys Argentinian soybeans other than they're testing them as a supplement for US soybeans for their reserve. They want to see if they store long periods of time. And so these are the things that we watch to better understand what's happening in China. But I would tell you that we in the United States are now not their main supplier. The first graphic here shows you that we are seeing our decline in, of course, graphic. And then if you look at monthly Chinese corn imports, we are in green. Notice here that back in December of 2022, China approved Brazilian corn for import, and they dramatically started up rampeting imports of Brazilian corn. And so this is China in terms of its diversification away from a single supplier, the United States. This is going to be problematic for President Trump as he tries to get China to the table. China has had 4 years to prepare for this trade war, and they're doing it quite aptly. So we've been asked this one graphic here is major Chinese crop imports. We at AgResource have it at 118, USDA has it at 134, though again, I didn't update this graphic from yesterday's report because I didn't have time. Nonetheless, you can see we're now on a slide, and people have been asking us where we see Chinese imports next year, generally speaking. This year, we've got China taking $23 billion of US ag goods, next year, $16 billion. Notice that I do not have a phase 1 or phase 2 agreement within this graphic because I'm doubtful the Chinese are going to spend $85 billion to get to the table in new negotiations. There is no replacement for China on world demand. I mean, when the Chicago Board of Trade or someone hears that China's buying, it's a big deal to traders. It's a big deal to U.S. farmers. There is no replacement. So as China kind of does a exit left, if you will, this worries me a little bit about farm income down the road. I'm not sure why some of this looks a little washed out, but you're going to see the same thing. The other thing that, if I look at these pie graphics here, in terms of where we're at, the thing that worries me a little bit in terms of is fertilizer. I say that because when you look at fertilizer supplies of Russia being, you know, in the case of phosphorus, China being 39%, Russia 6%, and then of course we have Belarus being 20%. These are problematics for the U.S. farmer. So if there is an Achilles heel, what I call this duopoly, this change in trading patterns, it's going to be in the fertilizer space. China's already banned urea, so if you think about nitrogen, if you think about potash, if you think about phosphorus, these are things that are going to be important down the road and leave us as American farmers somewhat at risk. My big concern is phosphorus, that chart in the middle. President Trump has proposed tariffs. I mean, this is not new. This is something that we heard of early last week. We'll see if the president will go forward in terms of Mexico and Canada. And again, if you're using tariffs to get a better deal, the art of the deal, I think that's all fine. Where I struggle with is if you're going to beat countries up every day with new tariff threats, that becomes problematic in terms of reliability of a supplier, uncertainty, where do you make decisions in the boardroom? And so these are things that are starting to worry corporate America. A little bit of history about tariffs. I pulled this graphic looking backwards in time. I want your eyes to focus on here. These are tariffs from 1820 to 2015. And notice in this graphic here that for much of the 1820 to 1930, tariffs were normal in world trade, in particular in world agricultural trade. These are things that happened every day. We had Smoot-Hawley, which had 2,700 U.S. products that came up, that precipitated the Depression to some degree, and we started to see a de-amplification of tariffs that have moved us to today. Within that de-amplification came things like most favored trading status, a lot of things in terms of the World Trade Organization that are now in flux and being changed. The one thing I would tell you all on tariffs is they're easy to put on, but history shows they're hard to come off. Even Trump's tariffs of 2018 are still in place today. So as an economist, what worries me is once you put tariffs on, what is the event that takes them off? These tariffs in 1933 came off from a depression. I'm not forecasting a depression, that's not what I see. But I do believe that we're moving into a different world on tariffs than we've seen before, and the days of those low tariffs down there are something that probably are going to change. The media today is that Trump is going to announce reciprocal tariffs against countries that charge us for our goods. And the biggest countries that are at risk of that are going to be countries like Vietnam, Cambodia, India, and China, and even the EU, but all of this again sticks to a different world than what you and I grew up in since the 1930s. The other thing, and I need to upgrade this graph, I did this a while back, but the other thing I would tell you is that the tariffs, the people that really get hurt are those that make less than $3 a day. The food insecure, those that do not have enough. And we can look backwards in time and you can see that tariffs, when we came to 1940 and the end of World War, how we saw the improvement, if you will, in what I call those living in extreme poverty. So as we move back to a tariffed world, and it's going to happen in general standpoint, you're going to see these people, food insecure, rising, and we can look at Africa or other places, but this is what worries me, at least in the short term, of what tariffs are going to do. Amongst the rising tariffs has also been something we call King Dollar. The dollar has been appreciating since President Trump was elected and the tariff regime was coming. He, of course, campaigned on that, and you can see that the dollar has been quite strong. If any of you are planning on taking a vacation, you don't want to go to maybe Orlando, maybe this is a time frame that you go overseas because everything's on sale. If you go to Europe, everything's 20% off because of the value of the dollar versus the euro. So think about those kind of opportunities. But in terms of commodities and you being U.S. farmers, I want you to think a little bit about the disadvantage or advantage that currency provides. You can see on the chart here is a Brazilian real, our biggest competitor. And then I plotted for you in prices of corn and soybean prices in real, corn prices in real, and you can see going backwards to 2015 how the Brazilian farmer has been able to continue to rapidly expand. I have an office, as I said earlier, in Brasilia. Every Brazilian farmer loves to have messed up politics. Lula's doing a good job of it. I mean, their budget deficit is crazy. They have no political plan going forward. They have lots of crime that's on the increase. Brazil's in a little bit of trouble, and that keeps the real going down. But if you're a farmer in Brazil, harvested yields, Brazilian crush and exports, they've all been going up together. And so part of the legacy of Brazil becoming a net exporter, the world's largest in terms of soybeans and corn, has been the weak currency that continues to provide profitability to expand within the country. I think, Bert, it was last year, I made a speech, and it was on the day that we gave this back in 2022, I think it was, that I mentioned that Brazil, on that day in a WASDE report, became the world's largest corn exporter. That's a crown that I don't think we would ever give up in terms of America, but it is now, of course, with the Brazilians, both on corn and soybeans, a little bit of flexibility year to year, but again, I think these trends are pretty ingrained today. And so if I can make it again, just showing you it another way, is if I look at corn, soybeans, and wheat harvested hectarage in Brazil, and a hectare is 2.47 acres per hectare, you can see we had 82 million hectares back in 2017-18. We're now at 102. That's like 45 million extra acres that Brazil has brought into production. It's demonstrative. This is why Brazil has become the behemoth in terms of world agriculture. And they're still approximately outside the rainforest, another 20 to 24 million hectares that are available to be brought into production. So Brazil is not done yet. And the same can be said in Russia. As the Russians got done with their oil fields, the oligarchs made their billions, they turned their attention to agricultural lands. They bought these massive farms that can be considered within, hundreds of miles of each farm, and you can see here that they heavily invested to take Russian harvested wheat yield up, and so we've seen this massive increase in yield. The acreage has gone up, and so Russia has become where the world wheat market is set today. Corn and soybean prices, to some degree, being set in South America and Brazil. Russian wheat exports are setting the price of wheat within the world, and so we in the United States are kind of now on the outside looking in, and the Chicago Board of Trade may not be well positioned for what's ahead. I just wanted to go through what's happening in the world landscape so you had a better idea of geopolitics and where we are today. Now we'll come back and talk a little more about commodity markets and where they sit. The corn market has had a rally here, thankfully for you farmers. We're back up at $5 a bushel. The reason for this, as you look, we think we're at some long-term resistance here. $5 a bushel or $5.10 for me is about the highest we can see. So I guess what I'm saying to you, if you've got corn and you're a farmer, maybe this is a place you start to make some sales. When I think of why we're here, it's really for two reasons. Brazil had a corn crop last year that was disappointing on weather. We had weather problems in the Black Sea, and both of them combined, the U.S. has a bigger export share, and that export share is helping the corn market improve. Now, we are planting the new Brazilian winter corn crop today called safrinha. Safrinha in Portuguese means little. It's not so little anymore. That corn crop is 100 million metric tons. It's a big crop, and so that 4 billion bushel crop will be available for harvest and export probably in June and July. So in my mind, the corn market has a few more weeks or months here to hang on. But if Brazil plants a new corn crop and you farmers plant 93 or 94 million acres in the United States, the corn market starts to roll back over again. So be aware of where we are in terms of timing and price in terms of corn. This is a graph here showing you global corn trade of the 7 major exporters of corn. Notice this year, though, it's the U.S. getting the business. It's not that world corn trade has been all that much better. In fact, if you look at the early shaded graphics there, we are mostly below where we were last year. In fact, if I look at where shipments from the primary exporters are, I think we would have your eyes look here. Notice on soybeans, we're down about 4 million metric tons. On corn, we're down about 1.2 million metric tons, and on wheat, we're down about 5 million tons. And so this is not telling you the world is buying more grain. In fact, it's static to lower. It's just that the U.S. has been getting a lot of the corn business. Thank God for Mexico. Mexico's been having drought. Mexico is seeing a revitalization of its economy because of its close proximity to the United States, and its livestock industry is building rapidly. And so Mexico needs more and more corn. Mexico this year will take $30 billion of U.S. ag goods. They are the largest importer of U.S. ag goods today. And so Mexico in corn has been a very dominant factor. On your right, you see Chinese corn imports, which were very big in 2020, which is why we went to $8 corn, and they've now been declining. So thank God for Mexico, for the American farmer. Now, how long the droughts last, I can't tell you, but it's still dry today, and Mexico is still struggling with drought. Maybe this is climate change, but you can see the highlighted corn areas here. They'll be planting here in about 4 to 6 weeks, and we need to get some moisture. Mexico's going to be back in the same position. Now, the good news for America is that Mexico rails a lot of its corn, so we kind of have a stranglehold on them logistically. They can bring some corn into Veracruz, but overall, we're going to keep this market even with tariffs from the administration. So this is important to understand. When I look at U.S. corn end stocks, they've been declining. And so when you look at this, we're at 1.54 billion bushels. USDA, of course, gave us that lower corn yield number in the January report. We believe it's a lot due to what we call dry matter. U.S. farmers harvested corn and soybeans very dry last fall because of the lack of moisture across much of the central U.S. Corn was coming off the field, 9 and 13%, where it should be 15.5. Soybeans, 9 to 12%. Average soybean exports today is 10.2%. So that moisture that wasn't in the seed wasn't counted in the USDA report, which gave us the low number. But if I look at U.S. corn exports and I look at where sales are at the late January timeframe, we are on track to meet USDA's estimate. So USDA did not change their export estimate yesterday. I think much of the good in U.S. corn exports is already built into the marketplace and built into the balance sheet. So this is helpful longer term. If you look at where corn end stocks are here today, USDA is at 1.5 billion bushels. Our own estimate within AgResource is 1.69. We believe that feed and residual will be, of course, lowered because this corn crop that is so dry is producing better feed conversion ratios in livestock and better conversion ratios in ethanol. Think about less water, you have more starch, more content. You, of course, don't need as much of it, but USDA won't decide that until we get to the stocks report in March and maybe June. So we've taken down our what we call feed and residual estimate, to some degree ethanol because of this, and we come up with a 1.69 billion bushel end stock. But for next year, if you farmers plant 93 million acres of corn, and of course making some adjustments on demand because of tariffs, I come up with 2.2 billion bushels for next year. And if you look at where price should be, maybe July corn can make it up to 525. That would be the upside extreme. I think we've been up to around 520. As you sit here today, this would be a market, if I'm a farmer, I'd be rewarding, and I'd surely be thinking about selling some of next year's corn crop, because if I end up with that end stock, corn prices will settle back with under $4 a bushel by next year's harvest. So just trying to enlighten you in terms of the opportunities that the market provides today. A little bit about soybeans here. If you look at world soybean production, and I stack all the major countries, whether it's United States, Brazil, Argentina, and others on top of themselves, you can see that we're looking at record soybean global production this year. The world is awash in soybeans. World soybean production will reach 425 million metric tons by our estimate. That's up 1.1 billion bushels from the year prior. So this is where the bearishness comes in the soybean market. Notice that the U.S. ship lineup has already peaked. We're now declining. And as you look at that one little square in there, this was the U.S.-China trade war from 18 and 19. And notice how that U.S. got compressed by that trade war in terms of exports overseas, which is something we should worry about in the soybean market longer term. Just late last week, we did conduct, through our Brazilian affiliate, a soybean crop tour down in Brazil. This is one of our agronomists. We did this with the Bank of Brazil, which finances roughly 74% of the Brazilian farmers. This is a big bean crop in Brazil. This is a really good bean crop. In fact, I point to everyone, when you see Brazilian soybeans, we held that beanstalk up for a reason. It is potted right to the end. You normally don't see that in Brazil. Brazil plants a determinate soybean. So we got to kill it with defoliate. We defoliate it. So by the defoliation process, we normally don't get that top quarter of the beanstalk producing, but this year it will. So our estimate from the crop tour is that Brazil will have a soybean crop somewhere between 172 and 176 million metric tons versus USDA's estimate of 69. So when you think about the world of soybeans, Brazil's got a very, very big crop coming at us. This is a little bit about why the harvest has been delayed. The market got a little concerned about the Brazilian soybean crop being late, but it was really due to planting progress. If I take planting progress and I look at harvest progress, notice now we're starting to ramp up rather dramatically. So I'm thinking that the Brazilians will catch up, and the chart to the right shows you that if I look at when the safrinha corn crop needs to be planted before there's a yield drag, it needs to be planted by March 1st. So we need to have 85% of the Brazilian corn crop in the ground on March 1st if we're going to have trendline yield. So both of these are important, but the soybean market's going to feel a lot of supply pressure in the next 2 to 3 weeks as the Brazilians really start to rapidly ramp up their, of course, harvest of that big crop. The other thing I want to talk to you a little bit about is China. USDA a year ago told us that China lies. Think about that. They don't tell us what their real trade is going on. And so it used to be that census data from China could be very trusted. And it's something we in the industry, I used for all 45 of my careers. A year ago, we started to see problems where the census data was appealing to President Xi, but it wasn't right. A year ago, I was out giving speeches and saying China's soybean import pace was understated by 8 or 9 million metric tons. Because the vessel counts, I have one person in my company that just follows vessels around the world, corn, soybeans, and wheat, where they load, where they offload, and we add tonnage. We now know today that China is importing soybeans. They're saying they're importing more than they do. Of course, Xi wants to look good to the world and saying, or to Trump and saying, no, we're buying all these soybeans. But from our work, we're finding out that as much as 9 million metric tons of soybeans, the Chinese are lying on. So not only do I have this big Brazilian crop, I've also got China, which isn't going to take as many soybeans as USDA is indicating at 109 million metric tons. We think this number could maybe be down at 100 to 99 to 101, and I've kind of plot there where China is relative to the skew where they need to reach USDA's forecast. And so when I look at this, this is overall concerning to me that our biggest buyer of soybeans in the world is actually taking far less than what USDA has indicated. Now, USDA doesn't usually make adjustments on the lying in China till we get into the March, April timeframe, because we need to get further along in the crop year for them to feel at ease. But I do believe that after USDA cut corn and wheat imports to China, they will make adjustments to soybean imports also. This all becomes very important longer term. Lastly, if we do the same thing on SKUs for our soybean market and look at where we're at, you can see here that if the market were to peak, some of our work shows that it should maybe we have July soybeans at $10.75. In fact, July soybeans made it up a little bit above $11 a bushel. So for us, that was a very big sell signal, if you will, in terms of where the opportunities were in the marketplace. So to us, the soybean market was fully valued or above valuations at $11, and we advise clients to start sales. And if you look at where the stocks to use ratio is, the trade did a very good job of getting where those stocks are. So if you look back at history, on a stocks to use basis, we are at the highest level that we can find looking backwards since about 2018 or 2019. So again, no reasons in my mind for a bullish soybean market unless we reach into a weather problem in the United States or the US could get some kind of trade deal with China. The biggest thing that's happening in my crushers, soybean crushers, is what we call the collapse in soybean meal. I have some meal plants today that are struggling to get rid of soy meal at any price. Some plants across the upper Midwest have dropped their basis levels. You see, this is Decatur, Illinois. This would be ADM soy meal basis, but some Crushers across the upper Midwest have dropped their basis levels to 70 under to try to get rid of soybean meal, $70 under Chicago. And we're seeing a big increase in influx of deliverable supplies into Chicago. So the point I want to leave with you, board crush margins are still relatively good at a little over $1, but because of this weakening cash basis level, my margin for a lot of plants in the Midwest is now somewhere under 70 cents a bushel. This is getting down to levels where crushers start to lose money. Somewhere between 60 and 70 cents, or let's call it maybe 55 to 65 cents, depending upon the age of your plant. Older plants need higher levels. You start to see where margin starts to turn negative. Now, we've not seen negative margins in the U.S. crush industry for the last 4 years. This is rather new, and it's the new crush facilities that have come on and the difficulty getting rid of soybean meal. So when you look at crush margins, this is crush margins on your left, you can see that when you look back to 2014, if we get under or near 55 or 60 cents, crushers start to cut back so that they can manage their margin. We also see on soybean meal here that we've now broken below what we call a long-term uptrend line. This is a monthly uptrend line, and this would project back to where we were back in 2016, somewhere around $250 a ton. I guess if you're in the poultry industry, this is a good thing because you're going to see your protein intake be relatively low cost and priced well. But if you're thinking about the U.S. crush industry and the health of it, remember that our soybean exports from the United States are now in decline. I need the crush industry to step up to keep us farmers going, but their margins are waffling on the negativity. So again, another concern for the soybean market as we have all of these new crush facilities online. We'll get another 2 of them this year. How do I get rid of the soybean meal and compete with Argentina and Brazil? That's the question that the meal market is going to have to ask longer term. A little bit about soybean balance sheet. Again, if you look at these numbers, a lot of them, I'm going to focus your eyes on end stocks in the United States. We are looking at soybean end stocks at around 380 versus 440 million bushels is our estimate at AgResource. We've cut crushings by about 30 million bushels. We're also some 30 million bushels under in terms of soybean exports, which is how we get to 440 million bushels. So up a little bit, and I think tariffs play into that a little bit here this morning. There's a lot of talk in the marketplace that because of the steel and aluminum tariffs that the U.S. had to endure, that the EU is going to come back and tariff things like soybeans and corn that we export to them. Not large amounts, but still enough maybe to have some impact. The other side of the graphic, I want to show you that the global stocks-to-use ratio on world soybean meal is at the second largest on record. So there's this abundance of soybean meal, not only in the United States, but also throughout the world. In Argentina, Miele is doing a lot to stimulate additional exports because they dropped their export tax, and this is causing somewhat of a flood, if you will, of soybean meal and soybeans on the market. Longer term, if you look at where we see end stocks, we're at 665 million bushels. We cut 2 million acres from planted. We're using a yield of 52.5, which is trend line. But our big difference will be in the export profile, because if Brazil really has 172 million metric ton soybean crop, the Brazilians will be exporting soybeans all the way till November or December of next year, competing with us in the United States in that new crop position. So I'm going to argue that that USDA forecast on their baseline report of 1885 is way, way too high. As farmers, think forward and think about the market. The other thing which I don't know completely everything about is what we call the renewable diesel industry. It used to be that under the Biden administration and the Clean Fuels Act, let's call it the Inflation Adjustment Act of 2021, there was going to be strong subsidies for the U.S. biofuel industry that started on January 1st, movement towards a producer credit. Now the Biden administration through Z45Z did give us some guidance, but they stopped short of giving us actual credit levels. So with a lot of my biofuel plants in the United States today, they are struggling because we have no subsidy. And I'm told that one of the things USDA and Elon are looking at is, we use subsidies to start out in the biofuel industry. We did it with ethanol. We've done it with soybean oil. Remember the blender's credit at $1 a gallon. But when does agriculture get off the subsidy, right? At some point, these fuels need to become standalone on their own. And so today, my renewable diesel clients are seeing a decline in capacity. We're cutting back because we're not losing money, but we don't know about our future. And so there's no clarity in terms of clean fuels and where we need to be. I guess I'd like to finish up maybe on a positive note here if I really could. If there's one market that I am positive on, it's going to be wheat. The wheat stocks-to-use ratio globally is quite good, and then in India, we've got an explosion in cash prices, which has taken wheat values up to $10 a bushel. India is the next demand driver, potentially. That would be good for wheat, that would be good for vegetable oils. The problem being is there's 720 million Indian farmers. Just think of that, 720 million. And so when you think about India, they're going to be rather protective of them. And so if India does import wheat, it's probably not going to be until after their harvest, sometime in, we'll call it June or July. But I do see reasons why the world wheat market could do better. And if I think in the United States, the U.S. winter wheat production did go up, but I think if you think about ending stocks, they're not going to be getting much larger. And so maybe there's a chance that the wheat market could be one of the support levels for the other grains. So again, remember that with the wheat corn price a couple of weeks ago at 60 cents a bushel is too cheap. That spread can maybe get out as much as $1.50 or $2. I don't want to be overly bullish of wheat, over bearish of wheat heading into the season. Actually, I'm really quite positive on the wheat market as we look into the spring. So if I could end up in a bullish flavor, it would be to wheat in terms of U.S. export opportunities. And in fact, if you look at different classes of wheat, it's probably going to be soft red winter, which you would grow here somewhat down into south or the Delta in the southern Midwest. Notice that the stocks-to-use ratio of soft red winter to hard red winter will be going in my skew in terms of where stocks should be in the average KC price. We're getting close to that now on the upside at around 620 to 625 on July futures. So again, bullishness in the wheat market leads me forward to things. All right, to finish up here, I'm going to talk a little bit about something that you probably don't hear a lot about. AI trading. How many of you guys market by AI? Anybody here in the room? Nobody. I'm working on a program and investing right now to do AI for farm marketing. We'll see how it all works. But I do want to tell you that in a lot of other boardrooms that I go, AI is becoming a big deal. And the question on AI systems is, what do you put into it to get the model to work to the best of the market, right? Do you look at fundamentals? Do you look at technicals? Do you look at macroeconomic factors? What goes into that? Well, notice in corn that back last summer when everybody was bearish, there's been almost a straight line of what we call managed net fund positions. These are speculative positions of a large nature in the market. They have bought close to 800,000 of corn. 800,000 contracts since September. In fact, in all commodities, we're looking at over $1 billion, and U.S. corn open interest, or Chicago Board of Trade U.S. open interest, is now at a record at over 2 million contracts. Notice that we've also seen others move up here. So when I look at managed fund net positions of everything, corn, wheat, soybeans, hogs, cattle, and feeder cattle, and look at index funds, the money has been rushing into Chicago. The money's been coming. They believe that tariffs are bullish and inflationary. And with that macro background, there's been a lot of investing on that side of the market. I believe that's why corn is at $5 a bushel, and soybeans in July has made it up over 11. It's been that flush of cash that have lifted us to where we are. But I think the market's also smart of this, and I want to kind of finish with where this would be. So my advice for all of you here today is what I call sell and defend. What do I mean by sell and defend? If I'm in your chairs as a farmer, I'm trying to maybe get some old crop sales sold or get to 80 or 85% sold on old crop. If you want to keep some grain for a summer weather problem and a free little gallop on that, that's fine. But I want you to think about new crop maybe getting to 40 or 50% sold at these prices. And I'll tell you why. And it's a strange little thing. These CZ is corn, December. SX is November soybeans. This is the contract of corn for 25, 26, 27, and 28. Soybeans for 25, 26, 27, 28 for the next 4 years. What does your eye see? They're the same. The market's smart. The market's telling you that I don't need to bid for more acres in the United States. I don't need to bid for more supply. As Brazil is, the world is still expanding, I'm just going to give you all the same price for the next 4 years. If this was a bull market, structurally staying longer term, you would have these corn at 464, December of 26 would be 494, December of 27 would be, I don't know, $5. It would have premium in there to reflect interest and storage charges and a desire to buy more acres longer term. The back end of the markets for U.S. farmers are saying, you know what, watch your margins, sell when there's profitability, but we're not going to bid up acres because today we're lacking demand drivers that need to take agriculture higher. It's not a story I like to tell. I would love to be here and tell you all that we had good times ahead and we're going to go back to $8 corn and $20 beans, but I'm here to tell you that we still need to strap ourselves in. Maybe Trump will get a trade deal with China. Maybe that'll change everything. Maybe there'll be a weather problem this year that will completely wipe this out. But as it sits today, the back end of the market is telling you that there's no reason to be aggressive there's no reason to be thinking about ever higher prices in a bull market that'll be sustained. So just a few things in closing. Oh, I want to go back to that. Just highlight, world geopolitics are changing fast between G7 and BRIC countries. Grain farmers in the United States are still economically struggling. U.S. government debt is going to accelerate. You know, we're now doing $1 trillion every 100 days in U.S. government debt, and I think the Trump tax holidays will get extensions. Brazil has become a behemoth with exports of 105 million metric tons of soybeans and 45 to 50 million tons of corn. And when I think about where we need to go longer term, China is going to be a lesser importer in the world. Net farm row crop income stays depressed, but U.S. grain farmers need a strategy. You need to know your cost, you need to know what the opportunity is, and you need to sell and defend. So I've been about an hour and 5 minutes. Bert, I think I've got maybe a few minutes for questions, but thank you very much, everyone, and I've appreciated spending this time with you going around the world of grain. Thank you.
Just right. If there's no questions, we'll just do the...
Yep.
Right. Okay, well, thank you very much, Dan. As you know, Dan has information-dense presentations, and we appreciate bringing all that detail to us. We do have a discussion session planned before we break for lunch, and so we're going to take our questions and discussion then as part of the panel. We do have break available now, refreshments, and we do have some tables we would like to announce. We have the Arkansas Rice with their information table, as well as the A-State Heritage Studies Program. The A-State Agribusiness Club invites you to come and look at their new shirts that they just ordered. All of you alumni can pick one up there. They're for sale, as well as the College of Agriculture ambassadors with information about the college and literature that maybe you or your family might be interested in. So let's give Dan another hand, and we'll break for the morning break. So please make your way to the Grand Hall and then return here promptly for the next session, which will begin at 10 a.m. sharp. 10 a.m. for our next speaker. Great job. Thank you, Bert. Nope. Our next speaker is a first-time presenter, but one that has been with us for several years now as a guest. Matuschka Lindo Briggs is a senior vice president and the regional executive, the manager of the Little Rock branch of the Federal Reserve Bank of St. Louis. One of her current responsibilities is to manage an entity called the St. Louis Fed Agribusiness Council. Before moving to the Little Rock branch, Matuschka held positions with the St. Louis Fed in community development, public affairs, and fiscal agent responsibilities for the U.S. Treasury. All of this was run out of she was in the St. Louis office at that time. But before the Fed, she had a career as a television and radio host and reporter with NBC and ESPN affiliates. She earned her bachelor's degree in journalism and communications from William Woods University in Missouri and earned her MBA from Washington University. Matuschka, thank you so much for coming today, and welcome back to Arkansas State University.
Thank you. You know, this stand hasn't been here until I had to speak. I just want you to know, but I'm actually going to come out here, but thanks, Bert. Bert's Fed family, so I really appreciate that. Thank you so much. I'm happy to be here. Before I get started, I do have to say this disclaimer, and it's basically that anything I say today, anything I tell you, anything I speak about, these are my views and what I've heard, not those of the Federal Reserve Bank of St. Louis or the Federal Reserve System. So a little bit of what I'm going to explain is I really want you to understand what we do and how it all works. I know everybody knows FOMC, you hear that, but how, what you do, and why we come talk to you is important. So first thing you can't hear me? Thank you. How about now? Good? Okay. So first, just going to give you a high overview of what the Fed does so you can understand why it's important for us to speak at something like this, why it's important for me to come to your farms, to see your factories, your plants, whatever. And then I'm going to share how we collect this information and why we collect it and what we do with it. And then finally, I'm going to give you the qualitative information that I hear in our district on ag conditions. So first, I just want people to understand that we are decentralized by design. So basically, you have the Board of Governors in D.C., 12 independent reserve banks across the United States, and we have 24 branches, and Little Rock is one of those branches, which is where I am located. And then you have the Federal Open Market Committee. So this is my favorite slide to help you understand kind of how it works. When you look at the Federal Reserve banks and the bank presidents, all 12 of us, we are private. So we are private entities. We are the banks for banks. We don't really work with customers per se on a basis, a teller, anything like that. So we're the banks for banks, and we're private, all 12 of us. If you come over here on this side, you'll see that the Board of Governors, that's your government sector of us. So that's the 7 governors. That includes Chair Powell, appointed by the President, confirmed by the Senate. So where we meet in the middle and align and work together and actually use your voice, the voice of Main Street, that's at the Federal Open Market Committee. That happens 8 times a year. That's when you hear about, you know, what the rates are going to be. And how that works is they meet, and it's all 12 presidents and the 7 governors. They meet all the time. But while 19 of them meet, only 12 of them vote. So you have the 7 governors that vote, and you have 5 bank presidents that vote. One president that votes all the time is the New York Fed president, John Williams, and that's because of international markets. Other than that, the other 4 presidents rotate. So this year for 2025, you have the New York Fed, you have the Boston Fed president, you have Kansas City, Chicago, and the St. Louis Fed president. So the president for our district is voting at FOMC. So the reason that's important is because the voice of Main Street, that's where that happens. That's where your voice is important, and I'll explain that a little bit more as we go. So this is our district. We're headquartered in St. Louis. We cover all or part of 7 states. We serve approximately 14.6 million people. You'll see that we have 3 branches. Again, I'm based out of Little Rock. We have the Memphis branch and the Louisville branch. That green area, it looks kind of green on this map, it's kind of lighter, but that's the 63 counties that I focus on. It's not a hard line, but when I have directors or ag industry council members, they come from that green area. But it's, again, not a hard line. Jonesboro's kind of the part that and Northeast are the 12 counties my Memphis counterpart's on, but if somebody needed me to speak in West Memphis, I obviously go. I also cover all of southern Missouri when I'm out in the field. So the primary responsibilities of the Fed, and my primary responsibility as a regional exec, is to promote stable prices and maximum employment. While we're doing that, I'm out, boots on the ground, listening to everything that's going on. And I don't do it by myself. I have a board of directors that help me. They're from various industries across the state, and they are also out there talking to industries and trying to understand. And the reason we do this is when people think of the Fed, they think of data, they think of research, but all of that has a 6-week lag. So when our president goes to FOMC and is going to help inform monetary policy, he wants real-time information. He wants to know, what are the farmers saying in our district? What are teachers saying in our district? How are the banks feeling in our district? What are the challenges? What are your pain points? And then what are your successes? What are you looking forward to? And what do you see in the future? So that's very important to us. So when I tell you that, please invite me to your farms, please invite me to your plants. I want you to sit at a round table when I'm in your community. I visited all 75 counties in this state. It's important for us to hear your voice. So how we share this information is an economic exchange, and how we gather it, I can't do it by myself, obviously, traveling around. So one of our key things is we have advisory councils. So we have an industry council, and we focus on 4 sectors, and that's ag, healthcare, real estate, and transportation. And I run the Ag Industry Council. So when we have that, I basically have every representative from our 7-state region. So again, we cover all or part of 7 states. Arkansas is the only state we cover the entire state. So I am the lucky one in covering Arkansas. We also do roundtables. I am talking to, tourism industry, manufacturing industry, workforce, again, is very important. I'm always trying to understand what's happening in the labor market, what's happening with supply chain. So this is one of our key ways of finding out what's going on. Our second thing is online surveys. So this is my request for you all today as well. If you think you could be interested in one of our industry councils, especially the Ag Industries Councils, Bert has my information, but I'd love for you to reach out to me. Because what we do is we put these people on a list so that they come to St. Louis twice a year and talk to us, and it's very confidential. We speak at a very high level. We're trying to understand the trends. It's not what's the name of your company or who exactly spoke to us. It's what's bubbling up to the top, what's happening in the industry, and what's happening across different sectors. So I'd love for you to reach out if you think you have time for that. But if you don't, the other thing we do is online surveys. So these are quarterly, and they take 5 to 7 minutes just to hear your voice so that we can input that and share that with the trends of what's happening with our president. We actually have one that just started last week. It ends on Friday, so if you're interested in doing that online survey, I'd be happy to mail it to you. Informal outreach, that's just me speaking to bankers, understanding liquidity, understanding deposits, what's happening with banks, what are their concerns, and then speaking engagements like this. Again, an economic exchange. I love to sit and hear what's happening, but I also want to share with you, which I'm getting ready to do, what we're hearing from you, not only in this state, but the people in our entire district. And then lastly, our other channel of gathering information is just, data sources that are out there, information that we can purchase, or reports that are out there being written. Where all this information goes. One, I work very closely with our regional economists, and I share all the qualitative information I get. Then they work with that research and with that data, and they connect the dots. And we're doing this between each FOMC cycle, so I'm out there quite a bit. The other place it goes, which I think is so great and would be important for you all to look at, is our beige book. So the last beige book came out January 15th. This beige book is economic summary of everything we hear happening in our district. Every Federal Reserve bank does this, so if you have companies or your companies across the United States, you could see all of this information. It usually comes out the Wednesday, 2 weeks before Chair Powell gives the interest rates results with FOMC. So it's Wednesday around 1:15. So basically in your mind you could think all the information that we've gathered, all the information that the president is going to share with Chair Powell at FOMC, this is what you're seeing before they even make their decision. So you can kind of see what's happening in your industry and what others are saying. Here's an example of, our last beige book that came out. Again, this is just for the 8th district, just basically talking about ag conditions and what's happened. And sometimes we will have a call out, but the call out again is very general. It could say, car manufacturer in central Arkansas, or it could say something in northwest Arkansas. Here they called out contacts in Arkansas pointed to lithium extraction opportunities as a bright spot for rural development that could support higher land values. But again, it's not detailed on names, just looking at the trend. Before I get into the qualitative information, this is something that is free that I think provides so much information, and I think looking forward and trying to understand your industry and where you're going, it's FRED, our Federal Reserve Economic Data. That fred.stlouisfed.org is the site. So it's an online database with hundreds of thousands of data time series. Bert, I'm sure your students, a lot of them use it. It can tell you delinquency rates on loans to finance agriculture, certain price indexes. The FRED category for commodities has almost 2,000 series. So this is just something that's available. If you want to understand consumer trends in any field, this is a great place to go. I do want to do a shout out to our 2025 Ag Council members, and I think I've seen a couple of them here. So Bruce Aronson, I'll just call out the Little Rock Zone ones from the University of Arkansas, Fayetteville. We have Jamie Anderson from Lone Oak. Let's see, who else do we have here? Jennifer James. She's here from Newport. And then lastly, the other one from my zone is Carter Malloy, and he's with Acre Trader in Fayetteville. So this is our 2025. You can see them on our website. They are so helpful. If I'm out in the field and I just hear something that sounds a little odd, these are the people I'll call and say, hey, is this really what's going on? Are you hearing this happen? And they're like, I haven't. So we're not looking for one-offs. We're looking for a trend, something that's emerging. So thank you to all of these people. And then I also wanted to say a shout out for, these are our alumni. Of course, Bert was on there. I usually see Keith Glover here. Is Keith here? Ah, there you are. Okay, there you are. So, and he's still, you all are very helpful to us still. I can call Keith all the time and he helps us out. So these are our alumni members that I just wanted to call out. So we're very grateful for all of the people that help us in our economic exchange. It's a two-way street. So now I'm going to share a little bit of our anecdotal information and talk about key takeaways in labor markets that we're hearing. So lots of activity in building poultry houses in Arkansas, which is leading to competitive wages. And this is probably the only place that we're seeing the real competitive wages now. That has seemed to die down since the pandemic. A large agribusiness firm noted that average starting salaries for new hires were lower than a year ago. So that's about the first time I've heard that. And most of this information that I'm sharing with you today is the end of Q4 and Q1. Row crop farmers and produce farmers say entry-level and responsible employees are still hard to find, and I would say that's in every sector. Every sector that we talk to, it's hard to find them. Not as far as, I think before, like a year or two ago, there was a minimal amount applying, like they'd have 5 or 6 applying. Now they're getting 50 applicants, but only 2 are qualified. So that's really the problem that they're having right now, and again, that's in every sector. Many farmers in our district would not survive without H-2A workers, so definitely a concern. Recognizing a future where employees need to lean into technology and AI. So this is something that's really bubbling up. We heard it in the speaker before, just having to figure out how do we get into more technology and AI to survive. A large agricultural company noted that attrition rates had declined in 99% of countries where they operated due to general uncertainty. Again, we're seeing this across the board. People aren't hopping over from farm to farm or moving for an extra 25 cents anymore. They're staying put. And then some mindset changes in farming. So this is something that we really started talking about in our Ag Industry Council this year. And it's just basically the conversation was things need to change. And some of the three things that bubbled up, one is rotating younger workers and teaching them all aspects. There's just not as many workers out there anymore. Again, this goes across all sectors. You can't just come in and be a teller. You can't just learn how to work one machine in any manufacturing plant. We just don't have enough people. So farmers are thinking the same. We got to bring them in young and we got to rotate them. Allowing for more family time and less weekends. I will tell you this was a lot of balk in our conversation. You know, one person said, but if the sun shines on Saturday, we need them on the farm, right? So something that it's a little harder for farmers to work with, but this is what, you know, your employees are wanting. And then finally, providing compensation packages like other corporations and benefits. Key takeaways in cost and pricing. Farm financial stress remain limited. Banks are seeing more stress in ag than usual, but right now they're not overly concerned yet, but this is something I'm definitely keeping an eye on this year. With the 2024 row crop cycle complete, producers reported limited profits as strong yields were unable to offset lower prices and higher input costs, pretty much what we mentioned in the beige book that I showed you earlier. Basically, equipment prices are low and the new farm equipment sales remain weak out there. Even leases, they're struggling with leases as well. Strong prices in the cattle market and other animal industries have supported revenues. Cotton and corn prices have increased since August, but remain below what they were at the beginning of 2024. Feed cost prices are lower, and there is also a reduction in energy and fuel. With the energy and fuel, something that we're going to do this year, this reminds me, is most of the different Fed banks have councils, some type of a council. They might have a different one, like Texas, their council is their energy council is very big. We've never done this before, but what we're going to do is we're working with the Atlanta Fed, the Dallas Fed, Kansas City, and ourselves, and we are going to have our ag industry councils throughout our districts meet this year. We're still planning it, we've never done, just to share the resources and the problems and to help us understand what's happening. We've kind of been very siloed in how we've been meeting, and we just think it might be more powerful in information and sharing what everybody's doing. So we're going to try that out this year, so I'll be excited to kind of report what we're seeing and how that's helpful. I haven't told our ag members that yet, so Jennifer's, I'm sure, thinking, what's the date for that? And then despite a significant rise in overall farmer sentiment following the U.S. elections, short and long-term farmland value expectations have fallen since November of 2024. So emerging trends. So emerging trends are really just, it's a combination of everything. We get the surveys, we get the reports while I'm out, the one-on-ones when I talk to you and I visit you, and this is just what bubbles up to the top. And this is really what we are looking for to give the president. It's what bubbles up to the top with unsolicited questions that we may not even ask, and they're just out there saying. So farmers in the district say they must have diversification and growing and be looking and considering all innovation. Again, that's across pretty much every sector, but probably the most in the last 3 years I've heard it from farmers. Using row crops for biofuels in the future is an up-and-coming trend. The ag industry, this is kind of what I talked about before, that they need to just change how they manage labor, and they need to do it fast. We need to do it fast to keep workers and to find workers, and that means paying more and more flexibility and benefits. This is across the board, and I've heard this across the board, across the state. Consolidation is a growing theme, so this is something we're really watching this year and a huge concern, especially in our district. You know, some in the district say the traditional approach to farming is a thing of the past. Keep looking for more acreage and purchasing it when it becomes available. Key theme. And lastly, to keep up with ag changes, again, this is just something that keeps coming up that I mentioned a little earlier. The AI, the technology, the data access, the data plants, manufacturers, or I talked to several manufacturers in the state that are really pouring money into their data centers and hiring young people to run those data centers to figure it out for them. Okay, I know you don't want to hear this, but I thought I would prep up Dr. Anderson. So, overall continued. Commodity prices have fallen. Overall production costs, such as fertilizer, equipment, fuel, and labor, have risen since 2022, and they remain elevated. For the past 3 years, water levels on the Mississippi continued to be lower than usual, so definitely resulting in higher shipping and transportation costs. So tighter finances in 2024 could lead to borrowing for this planting. So really talking to bankers too and seeing what they're seeing, especially this is the time of year. They're trying to determine that underwriting and, how do you do that with all the elevated risk and what have you, and it's just difficult, to see what the future entails. So that's something that's happening. Real quick, if I'm okay on time, Bert, I just want to share a little bit what I'm hearing in other industries because it kind of curtails in what you're doing. And again, like I say, a lot of the sectors have a lot of overlap. In tourism, it's very positive, but definitely signs of slowing. Everyone's very price sensitive. If there is a theme park out there that hasn't raised their prices in 5 years, well, last year everybody was complaining about the prices. So any type of experience, tourism, people are starting to really, really be price sensitive. Auto and retail, weaker sales than a year ago. Retailers and auto dealers indicated they needed to do promotions. Of course, we've already started to see some layoffs in that industry. Manufacturer, well, obviously with the tariffs and everything, they're scared. They're looking at aluminum, copper, and steel, and there are major concerns in what's happening. So the uncertainty is causing great concern. Real estate, fewer transactions, but prices are holding up. So the new home business, it's doing well. They're still building, but those people that have those low interest rates, as you've heard, they're not moving. And there's just a lot more of remodeling and, the existing home sales is weak. So we're waiting to see what happens there. We talked about agribusiness, the high yields not expected to offset lower prices. And finally, banking. We're hearing mixed reports. Competitions for deposits has been easing. For the most part, I think we've heard that the savings that people have had, they're back down to where they were before the pandemic. Those high savings accounts are no longer there. They've kind of gone down. So really watching consumer spending, really watching consumer behavior and what they're doing. And I'm going to end with this. This is one of my favorite quotes from Chair Powell that he said last January 2024, because I really think it shares what we do and that people don't understand that it's your voice that goes to the FOMC table. So he said, the best network of anyone. In all their districts, they're talking to the business community, educational, medical, nonprofit community. That's what goes into the Beige Book. Each Reserve Bank president during the outlook go around, they'll say, in my district. So like I said, while only 12 vote and only 5 presidents are voting, they're all speaking, all 19 are sharing information. And I love that he says, based on 100 conversations with people of all different walks of life, I personally find understanding what's going on. And also, I think you hear things before they show up in the data sometimes. So that is so true. And those 100 conversations, again, we're doing them in between each FOMC speak. So again, my last request is please reach out to me. We're grateful to our Ag Council. I love working with them, and I'd love for you all to be in the lineup to be part of that council and to be our survey. So your voice is important. So thank you for helping me with all I do. Thank you.
Thank you very much, Matuschka. She'll be participating in our panel discussion later this morning. Let's move on, and John, if you'll join us. Our next speaker will focus on the issues and outlook for Arkansas agriculture. He is an economist, Dr. John Anderson. John is a native Arkansan from Timbo, Arkansas. He did his bachelor's degree at College of the Ozarks and then joined us here at A-State, did his master's degree in agricultural economics here, went on to graduate school and PhD at Oklahoma State University, and then faculty positions around the country at Mississippi State, University of Kentucky, and then a stint in Washington with the American Farm Bureau Federation. John has been back in Arkansas for a while, in Fayetteville with the University of Arkansas, Ag Econ Department, and most recently, a year ago, the director, he's been appointed the director of the Arkansas Cooperative Extension Service, based in headquarters in Little Rock, part of the University of Arkansas Division of Agriculture. And so, John, I thank you so much for coming. John's been here before, but I believe he was with, I know he was with the American Farm Bureau at that time. And John is working with the Extension Ag Economic Capacity of the Division of Agriculture, building that up, which is important to our producers and businesses during this time. John, thank you for coming today.
All right. Can you hear me? This was on. There we go. It's an honor to be here. It's always a privilege to come back to Jonesboro and Arkansas State, and I appreciate Dr. Greenwalt extending the invitation for me to be here. I want to thank all the county agents and extension personnel that are out here. I've seen a lot coming in and during the break, and I know it's a busy time of year, and appreciate y'all coming out you can hear me anytime. You don't have to come here to hear me, but thanks for doing it. I'm not gonna lie, I've done a lot of market situation and outlook and economic outlook talks in my career as an ag economist. I was thinking last night, I think the first situation and outlook talk I ever gave as an extension economist was in 1998. And as I recall, it was pretty grim. Not that the outlook was grim, my presentation was just grim. It was the first one I'd ever done. I've given outlooks during happier times than this, I'm not going to lie to you. And these are easier to give when things are good and everybody's happy and the outlook is stellar. We're in a challenging time in our agricultural markets. And I want to go through that with you. I'm going to plow some of the same ground that Dan did earlier. I felt a little better. I thought I had a really negative talk until I heard Dan, and I felt better about mine. But I think his was unfortunately very accurate as well. I'm going to plow some of the same ground he did, but maybe go from a little bit different direction and get not so much into the outlook side of things as what the economic situation is and the implications for our state. Bert asked me to talk about issues in agriculture, and this is a very brief list. This is a list I put together in probably 20 seconds, and the reason I didn't think a whole lot about it is I'm not really going to get much past that first issue. Economic stress in the commercial row crop sector is what I'm most concerned about right now in agriculture. We do have other issues floating around out there. Obviously, there's a pending farm bill. We assume there's a pending farm bill. I think Dr. Greenwalt said last night he had Keith Coble come 2 years ago to talk about the new farm bill that we didn't get, and then he had Joe Outlaw come talk about the new farm bill that he didn't get. Now he's got Mary Kay here to talk about the new farm bill that hopefully we're going to get. But I'm going to kind of leave that off and let Mary Kay talk about that. Trade is a big issue, and it's kind of bound up in this first topic of economic stress and kind of getting beyond the row crop sector. We got high path avian influenza, big deal. Potentially a huge deal for this state, being such an important poultry state. Not even going to touch that today. Farm labor, Matuschka's talked a little bit about that, not going to touch it. I'm going to park right here on economic stress and talk about what that means and what I see for the state in that. And to kind of set the stage for that, and this is kind of a preaching to the choir deal. I'm sure you all are aware of the significance of agriculture to the state of Arkansas. We are in a region of the state right here that is the most dependent on agriculture. In a state itself that's very dependent. So this is what you're aware of, but it doesn't hurt to be reminded 1 out of $7 in Arkansas ties back to agriculture. 1 out of 7 jobs in Arkansas tie back to agriculture. So the health of agriculture is intimately tied to the health of this state's economy. And so when we talk about economic stress in agriculture, particularly the row crop sector, big deal for the state, obviously a big deal for eastern Arkansas. Another way of looking at this is Commerce Department data on gross domestic product, gross state product, and very simple calculation here. This is just the component of gross state product that's attributed to agriculture, forestry, fishing, and hunting on a per capita basis, divided by population, to put that on a per capita basis. Per capita impact of agriculture in Arkansas is much bigger than any of the states around us. This is almost a kind of Midwest level of significance of agriculture in Arkansas. So this is an agricultural state. What happens in agriculture affects everybody in this state, either very directly or indirectly in a very short chain. So this topic of what's going on with farm income and what's going on with the economic situation in agriculture is of relevance well beyond the kind of farm-centered audience that we have in the room with us today. So I want to start going through some of the farm income data that Dan talked about a little bit earlier. Look at it a little bit different way. I want to preface that. A lot of you know Joe Outlaw. Last year Joe was here, right? So Joe's a good friend and does good work at Texas A&M and the Ag Food and Policy Center. This is an article that Joe and his colleague Bart Fisher wrote on Southern Ag Today at the end of January. In 42 years, it's a little small, so I'll read it to you. In 42 years that the Ag Food and Policy Center has been projecting farm financial performance, the most recent crop outlook for the representative farms is the worst in terms of the number of farms in each of the 4 commodity types that are not currently expected to have positive cash flow over the next 5 years. What makes this so troublesome is there's not a crop that producers can switch to from their current crops that would generate a positive return. Where is the safe harbor that you can run to? I was telling somebody at break, I remember doing market outlook talks in the early 2000s and talking about, and things, we had bad markets then. Had a lot more of a safety net then, but we had bad markets. And I remember several years talking about how, if all else fails, you could plant soybeans for the loan rate and kind of hold your money together. Some of y'all remember what the loan rate was then? $5. But that was a place you could kind of hide. What Joe was saying here is that there's really not a crop to jump to that's given a very good return. So kind of across the board, returns look fairly weak for 2025. Now I think that's masked if you look at the farm income data. And for people who aren't really familiar with agriculture and run to the net farm income data to kind of diagnose what's going on in agriculture, I think this is kind of misleading right now, because if you look at this just came out, I didn't include 2025, there's a 2025 forecast. It's not as relevant for what I'm talking about right now, but if you look at the most recent forecast, $142 billion, a real net farm income, if you look at that across that last 25 years, it's not horrible. It's down a couple of years in a row, but compared to that historic average, it doesn't look too bad. But there really is a tale of two markets going on here, and Dan alluded to that in his talk. The livestock and poultry sector, things are pretty good, really strong returns. And so this net farm income data includes all of agriculture. On average, across the whole sector, net farm income looks pretty good. But this is masking, I think, the weakness that we see in the commercial row crop sector. And I think it's important that we communicate that to people who maybe are outside of agriculture, maybe who are kind of casually connected to this and looking at things like this and saying, hey, the ag sector looks like it's okay. The ag sector as a whole looks okay. But the pressure is really in the row crop side right now. And you can see that. You don't have to dig very deep to see that in this data. Within that net farm income report, the cash receipts are reported out by crop and livestock sector. And this is, you see a real dichotomy here between crop cash receipts in blue, which have gone sharply down for the last 2 years, and animal product cash receipts, which are, back about up to where they were in 22 at kind of a record level. So that aggregated net farm income can be a little deceptive, and we need to, I think, be clear about that the crop side is where the pain is right now. So with that, you've got a pretty sharp drop, 2 years of a pretty sharp drop in cash receipts, and at the same time, income costs. If you look at where we have gone, this is the percentage change in input costs since 2019. We've come down a little bit in some of these inputs, particularly manufactured inputs have come down some since 2022 when they were really extremely high, but we're still sitting 10% because these are the three major categories of input costs that are in that net farm income report, still 10% higher than we were pre-COVID, at least. I think that's kind of an at least idea. What's happened with prices? Well, we're back for the most part at or below where we were pre-COVID. So cash receipts about 5% higher than they were in 2019 right now. Costs at least 10% higher than they were in 2019. Prices haven't returned back to about 2020 levels. So that's a picture of the squeeze, the price cost squeeze that we're in on the crop side. You drill down a little bit into some of these production expenses. This is not exhaustive of all the categories that are in the net farm income data by any means, but I wanted to pull a few out that I think are representative, some of the bigger ones, and also kind of representative of where things have gone. If you look at these total costs, kind of a little more detailed look at what I was showing through the changes, percent changes since 2019, costs have gone up and stayed up. That's not news, I don't think, to anybody who's operating a farm. But again, I think we need to dig into these net farm income numbers and explain that. The biggest thing that I think is different right now from other down market situations I've seen in the crop sector is that in previous episodes where we've had weak markets, and again, I'll go back to the early 2000s as a time when markets across the board were fairly weak. At that time, we had a fairly robust farm safety net. Farm programs were meaningful in terms of the contribution they made to farmers' bottom lines. The 2002 Farm Bill included direct payments and countercyclical payments, and there were several years under that Farm Bill where several of our crops in the Mid-South drew full countercyclical payments. So we had weak markets, but we had a pretty robust safety net. And that's reflected in those fairly high levels of commodity payments that we received. Look at where we are in 2024 in terms of commodity payments. We've got an obvious, the data shows that we've got obvious cost price squeeze affecting our farmers. Our experience tells us that. Commodity programs really aren't contributing a whole lot to farmers' bottom lines. And that is I think, in my professional life, what is different right now than in previous episodes. If you add ad hoc payments, the situation looks quite a bit different. The big spike here in 2020, that's a lot of COVID money, and that's the trade assistance money. That's the trade war ad hoc support that came in. That's been significant money over the last few years. Not so much in 2024. Certainly makes us look a little better. A lot of that is disaster relief money, though, that's not really affecting the row crop sector. So the point there is that this is a situation where the safety net, this is a situation that exemplifies why you have a farm safety net, and we really haven't had one. We haven't had one that has been effective at supporting farm incomes. And we'll talk about that a little bit more as we go through. But some assistance is on the way. the continuing resolution passed in late December included not just an extension of farm programs, and again, I would say those farm programs, we certainly want them extended until we get a farm bill renewed, but those programs haven't been contributing a whole lot. But there was $10 billion in economic assistance for Title I crops. Now, that's not a small amount of money. Let's roll back here a second and look at where we are in 2024. $10 billion would put us up here, and I don't really have a pointer, so I hope you can kind of see. $10 billion would put us up to about the middle of that screen. That's a pretty significant infusion. So I don't want to minimize the support in the continuing resolution. That would move us back more to those historical levels of safety net support in the middle of a bad market, which I think is something that's very much needed. We are still obviously waiting on that, but that is going to be an important addition to the bottom line. And most of that $21 billion is disaster assistance that I don't think is going to find its way to addressing the issue that we have in the crop markets in the Mid-South, but the $10 billion certainly is. And that's why I didn't show that. Dan showed the 2025 farm income forecast a second ago that included the effects of that $31 billion. I guess I spent enough time in Missouri in my life. I'm a show me kind of guy. You show me that and then I'll put it in my chart. And I do think it's coming. Very much needed. Here's what it's going to look like in terms of breakdown. I stole this slide from Hunter Byram. Hunter's in the room somewhere. Hunter, where'd you go? Okay. I want to give Hunter credit for this. He and Ryan Loy are extension economists in my shop, and they've done a great job putting together some market outlook work, and I've stolen some of it for this talk, but I wanted to make sure they get recognized for this. These per acre payments actually, again, look pretty meaningful in terms of our historic levels of farm support. Estimated payment on corn, $43.80 an acre. Cotton, $84.70. Rice, $69.76. Soybeans, $30.61. I've read some things lately, and again, I got some conversation with Joe Outlaw I had that this may be kind of a best case scenario because there's $10 billion and that's got to be allocated across a lot of crops, not just the ones that you see on this screen. But that's probably the ballpark that we're looking at in terms of support. And again, extremely helpful. I think if you look at kind of where we were in 2024, these numbers would get us back close to a break-even kind of situation for the 2024 crop, at least on corn and soybeans. Actually, some of you may keep up with Farm Doc daily. That's guys in the Midwest, their daily extension summary. Gary Schnitke and Nick Paulson and Jonathan Koppas actually wrote a piece about these payment rates when they came out. Their take on it was that for corn and soybeans, which is all they really were very concerned about, those payment rates would be just a little bit under break even for their estimated 2024 returns. So it gives you some idea where we are with support. Pulling us back to about even is what we're likely to accomplish. Now, looking ahead, and again, these slides come from Hunter Byram and Ryan Loy, looking at a break-even matrix for our four major crops. I'll start with corn here. So across the top, we've got yields, and down the side there in green, we've got different prices. And it's based on our enterprise budgets. Those are the levels of return associated with those price yield combinations. The big question is, where are we going to end up in this matrix? The corn market's improved some since this was put together, and that's been the market that's actually shown some life. And if there's something to be bullish about in our crop mix here, it's probably corn. In my opinion, I'll defer to people like Scott Stiles who do this now more than I do. But I think fundamentally the demand side looks decent for corn, and we've seen world stocks come down. So maybe we can move a little bit further down this left-hand column of price And if we're in that, say, 450, 470 ballpark at, between that 188 and 200 bushel yield, we're right there on the bubble of break even. We're somewhere between losing a little bit and making a little bit, but nothing super exciting, but there is at least a decent prospect of some black ink. It looks like right now if you look at corn. If you look at cotton, there's a lot of red ink on that. I know this is to the farm gate, and I know there's some value add prospects in the gin that we don't try to capture with these farm level enterprise budgets, but we're a long way from profitability on these cotton budgets. Rice, some improvement there in rice, but if you look at you can kind of see where you think your farm is going to slot into this, but if you're at that somewhere between that 613 and 674 price at around 170 bushel yield, again, that's pretty close to a break-even proposition. Looking at 2025, and again, if you just for context, that rice payment of $70 an acre. Good prospects that would put us back into a situation where we're a little bit above water, but certainly not getting fat. And then soybeans, again, I think this is consistent with what Dan was saying, a somewhat bearish outlook on soybeans. If you look right around that $10 mark at mid-50s yields, we're still a little bit underwater in our budget projections on that. And again, we can quibble with these budgets. When I started my career, everybody would look at budgets and say, y'all's budgets are way too high. It doesn't cost near that to grow a crop. And now when I show budgets, everybody's like, y'all's budgets are way too low. It costs way more than that to grow a crop. So I don't know if we're hitting this exactly right, but I think we're pretty close. And again, I say this many times when I use budgets, our budgets are meant to be representative, not definitive. You should take these and put your own numbers in and do your own work, but in our representative budgets, we're looking at a break-even, at best, situation on corn and rice, and probably losses on cotton and beans. So don't throw anything at me initially. You can, but please wait a second. I don't want this slide to be offensive. I added this slide after a conversation with Dr. Greenwalt last night. So if you ever had Dr. Greenwalt in class, you know that you were going to do your homework, right? So I did my homework last night. And this is I don't want to trivialize this exercise. This is a pretty basic concept, but we're sitting here looking at how do we get to break even? That's really what a lot of us are going to be thinking about as we make our plans for this summer. How do we get to break even? We'd love to make some money. Hopefully things will change and we will make a little money, but how do we get to break even or a little beyond? The math is pretty simple on that. You can either increase revenue or lower costs. How do we get to higher revenue? Well, a positive demand shock would do it. Maybe it would certainly help. That would be a great trade deal with China that opens the floodgates and sends our product overseas at a great price. A negative supply shock would do it. Hopefully somewhere else, like Brazil. We don't wish bad on anybody, but if their yields could be off 10 or 50%, maybe it wouldn't hurt our feelings too much this year. That kind of supply shock would boost our price, get us over the hump of break even. And then, of course, what we're all talking about is farm bill support. There's been a lot of talk about changing reference prices, doing other things that would increase that farm bill support to get us over that hump, get us better than break even, or at least to break even. I think that's what most people are asking for right now. Let's just, if we can get to break even for 2025 and fight another year, we'll call that a win. This is, and again, not to be negative, on the revenue side, this is kind of the strategy of hope. There's really nothing we can do individually about most of that. The other thing we can do is reduce costs, and this is where I didn't want you to get mad and throw things at me. You lower costs through efficiency gains, which most of you have already done, right? I don't think there's a lot of inefficient producers in here, and I want to be clear about that. If you have survived in farming to this point, you're pretty efficient. We have people at the University of Arkansas who have devoted their lives every single day to trying to squeeze a little bit more efficiency out of our production systems for our farmers. We work very hard on that. I think they would tell you, and I will tell you, there's not a lot of low-hanging fruit out there, and I think that's true on the farm. So I don't want to insult anybody by saying, hey, get more efficient and you'll be in better shape. Very efficient. So what does that leave? We're kind of down to the last strategy. You try to negotiate lower input prices. In economics, we tell you all the time that farmers tend to be price takers, which means you don't have a lot of negotiating power. About the only dial you can turn is related to land rent. And this is all build up to say I think there's going to be a lot of pressure on land rent, not just in the Mid-South, but across the country. Anecdotally, that seems to be happening. We've had 2 years of significant drop in revenue without much change in price. There has to be some kind of pressure on land rent. I don't know what y'all's experience is in terms of how that's adjusting. That tends to be a really sticky price in our systems, but I think there's a lot of pressure. The current situation creates a lot of pressure, and I know a lot of you are probably having difficult conversations with landowners right now about this very issue. And the reason that's going on, again, what I think this slide is meant to emphasize is that's really about the only dial that you've got much control over right now. And you probably don't have as much control over that as you would like to have. In summary, farm profitability in the row crop sector is, I would say, at a historically low level. I think we can go back and say, like, it's the worst since 2016 or whatever that number is. I think the real pain is probably a little worse than that. And again, it goes back to there not really being a safety net that's effective right now, and there not being an alternative, an obvious alternative to jump to improve your situation. That's what I think when I say this is a historically tough situation. Those are the two things that I'm really talking about there. We've had bad markets before. We've had low returns before. But with really an ineffective safety net and without something out there that's got some at least somewhat bullish prospects to jump to is a really tough decision environment. And I certainly wouldn't want to minimize that. Tough environment to make decisions in. The positive thing, if there's something positive I could say, it is that prospects for 2025 have improved some in the last few weeks. Again, corn has popped up some. Dan did a good job explaining what's behind that. Sounds like it's something to try to take advantage of in the short run. I'm not sure if it's going to have legs, but at least there has been something that has rallied in the last few weeks to make things look a little bit better than it did, say, 5 weeks ago. Commodity support payments are at historically low levels, and again, you've got to look at that in the context of where we are with returns. If we had historically low support in 2010 or 11, no problem, right? We're really not that concerned about what the safety net's doing for us in 2010, 11. Those were really good years. Now it really matters. ARA payments, the American Recovery Act payments, that is going to be a significant boost. When that is worked out and those come, I don't want to minimize that. If you look at, put $10 billion in the context of our historic payments, that's a significant boost to bottom lines. I think it is indicative of really how stressful 2024 was that we're talking about that being kind of a break-even infusion to us for the most part. Policy uncertainty is certainly compounding the problem of a weak market outlook. When will we get a farm bill? What will be in that farm bill? What will we be able to negotiate in terms of an improvement in reference prices or a new program design that raises the safety net to a level where there's meaningful support in it? Right now, that is all pie in the sky. That uncertainty, again, the difficult environment, the decision environment that we're in, looking ahead to the 2025 crop and what we do, difficult decision environment and that policy uncertainty is not making it easier. It's actually making it a little cloudier right now. And so hopefully we'll get some resolution on that. I know I've got great confidence in Arkansas's congressional delegation, and we've got some great people in leadership positions in DC that I'm confident understand this and want to see this improve. So, you know, John Bozeman, I think, has as good a grasp of farm issues as anybody in Congress at this point in his career, and we're fortunate that he's sitting in the seat that he's in. So again, I think that's maybe a cause for optimism here. As we face this policy uncertainty, we know we've got a friend who's in a position to help deal with it. So that's a good thing for us, and look forward to movement on that fairly early in the year. Now, I want to close real quick, and I have no idea where I am on time. I think I'm okay. Talked about farm markets and talked about farms. I want to talk for just a second about people and people in this room. Farm stress is a real thing. Financial stress does bad things to people and to families, and it's a hard thing to deal with. And I want you to know, if you're a farmer in this room and you're having a hard time right now, and I think some probably are, you're more important than your farm. You mean more to your family and your community and your friends than your farm does. And I think we'd be remiss, I would be remiss, having the opportunity to have the microphone today, I would be remiss if I didn't make sure you heard that from at least one person today. As we talk about a bad outlook and hard times, you are more than that as a person. And you may know somebody who needs to hear that in your life. And if you do, I hope you'll be faithful to share that with them. If this is something you struggle with, or if you know somebody who struggles with this, we've got a lot of farm stress resources at the University of Arkansas. Again, this is not just if you're struggling with this, this is for you. A lot of this is related to training to help recognize farm stress and strategies to help other people deal with it, to be an advocate and a support for people who are dealing with this. So if you have an interest in that, and in our communities we should have an interest in that, we've got resources to help. And I wanted to make sure you saw that before I got out of here. So Bert, I will stop with that and welcome my good friend Mary Kay. I will tell Mary Kay and I worked together at American Farm Bureau. She did her best to train me in ag policy. I wasn't a very good student, but she was an excellent teacher, and I'm really excited that she's joining us in Arkansas today. And not to step on your introduction toes, Bert.
Well, thank you very much, John. Our final speaker for the morning session before we begin our discussion panel is Mary Kay Thatcher. Mary Kay was with us just a couple of years ago, and she's back to talk about this Farm Bill situation. And so you've heard this a bit earlier this morning. The Farm Bill was a 2018 Farm Bill that expired in '23. It's been extended twice since then, but because of the changes in price relationships between inputs and outputs, even though it's currently extended for the '25 crop year, it doesn't really provide any significant economic assistance as a safety net. So John just mentioned we do have representatives from Arkansas on the House and Senate Agriculture Committee, and John Bozeman chairing that committee. So there's a lot that's going to be going on this year related to agricultural and farm policy. Mary Kay followed this for years with the American Farm Bureau Federation, and for the last several years with Syngenta Government Relations. So Mary Kay, thank you for coming today and shedding some light on what to expect.
Thank you, Bert, and nice to be here. I was here a couple years ago, so evidently I didn't screw up too badly. Nice to come back, and certainly great to follow both Dan and John. And you know, I think you're going to see some very similar slides. That makes me feel good because two people that I respect very much have many of the same viewpoints as what I wanted to share with you today. And I just wanted to start, you know, maybe 6 months ago, a friend of mine said, Mary Kay, what's on your bingo card for agriculture? So I put this together. I probably could have put 3 more bingo cards together with all the issues that are facing farmers and ranchers in Washington, D.C., but I think these are going to be the highlights. And if you haven't played bingo lately, you may remember that middle square is usually a free space, but I decided it was really important to put in there just the importance of President Trump right now in everything that's happening in Washington, but certainly with respect to agricultural issues. So I do think this is the major points that we'll spend our time on this year. Am I pushing the wrong button, Hunter? Doesn't seem, I'll push this button, then maybe you can help me. There we go. So, very clearly, this is not Groundhog Day by any means. I've been in DC doing this kind of work for like 40 years. I've never seen anything like it right now. For me, it's way more like Forrest Gump saying, you know, you never know what you're going to get out of the box of chocolates. And that's what happens when you wake up every day right now, is you just really don't know what's happening here. So you see on the right-hand side, I put up the number of executive orders that have happened. You can see Trump's way out there. This is actually the number of executive orders that those presidents have done for the first 100 days. So we're way ahead, you know, can you believe it? 23 days ago, where were we? We were watching an inauguration. Isn't it amazing what's happened in 23 days? So it works, thank you. So thank you. I don't think, however, that the executive orders are done. These, the numbers there on the left are the number of executive orders that those presidents have all done over their 4-year term. As you can see, they're trending down. I'm going to be absolutely amazed if Trump doesn't exceed at least his 220 that he had. So I think you're going to continue to see it happening. As you see, at least from a couple of days ago, most of them have come up with the reshaping the federal government, with foreign policy, et cetera. No surprise. I put this up here, man, if there's a person in this room that knew that President Trump did all these things in the last 21 days, please tell me. It is, like I say, hard to pick up because every day it seems like there's more and more executive orders that come out. They go all the way from small to big, but I think the couple that have come out that are going to most affect agriculture in the longer term are certainly immigration and the trade policy and tariffs. So really the big question in my mind is, what authority is he really going to be able to get by with? And are the courts going to give him the ability to look at things like shutting down agencies like USAID? Are the courts going to give him the authority to say, okay, Congress told you to close TikTok, but you're keeping it open, et cetera? Just yesterday, I said the orders go from small to big. He actually did issue an executive order yesterday that said we're not going to have paper straws anymore in federal government food services place. So they're not all massive things that are probably going to have much issue, but I think the courts are going to be very involved. Certainly, I suspect that the first things that happen are you're going to get many court decisions that will say no, 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 because the people that filed the decisions go to the very democratic court justices and they say no. Then it'll go to appeals court and eventually it gets kicked up to the Supreme Court. And actually, I suspect that the Trump administration really wants that to happen in as many cases as possible because they've got a pretty conservative Supreme Court right now. But I think a lot is going to hang over the next few months on what happens with these court cases. Now, there is no question right now but what Trump is in charge. And he has a tremendous amount of leeway. And I'm going to use the word right now that Trump right now is somewhat of a dictator. And I don't mean that negatively. I just want to impart how much authority he is imparting in Washington right now. Way, way more than I think we have ever seen a president do. And I think it's for several reasons. But one of the things is he obviously is promoting a lot of chaos. I think Dan asked what the word was, and I heard chaos 3 or 4 times before anybody else this morning. I think that's his idea. Throw things up, create as much chaos so people focus over here, and the next day he does something else and it's over here, and he's hoping that the things that are really important slip through and he indeed gets them done. Whether he continues to be able to have that great amount of leeway, I think is questionable. I also threw together here what I call watch-outs, things I just think we should be aware of, we should keep in the back of our minds. And, you know, I think it's interesting. If I think about EPA, there's an office there called the Office of Pesticide Policy, and their whole function in life is to look at registering pesticides and then re-registering them every 15 years. And you can see from the chart on the left, we've really significantly decreased the number of employees who do that. But I asked myself, you know, if I go to the Hill, and we go to the Hill as do all the farm organizations with companies like mine and Bayer and Cooperative, and we lobby for more money for this Office of Pesticide Policy so we can get newer pesticides out there, we can get them to you, presumably they're safer, presumably they're better than one that was developed 20 years ago, et cetera. And every time you go, people say, what are you doing here at lobbying for more money for EPA? What the heck? So it's always a sales job. But think about it now. We're going to be up there looking for more money. I show you the number of staff we have. Certainly, the president has been very clear that he intends to take several agencies and/or departments and move them out of Washington. If you remember, in his first administration, he moved the Bureau of Land Management to somewhere in Colorado. At one point in time, he decided to move the 100 or so ag economists at the Economic Research Service at USDA out of town. I think a total of 5 of them out of 100 moved to Kansas City. People said, I don't like Kansas City. My wife or husband likes working here in DC. My kids are happy in school. I just don't want to do it. So obviously, ERS suffered greatly for a while. I think they're still only back up to about 60 or 70 of those economists. We're still suffering from that. The same thing will happen whether it's an EPA move or a Bureau of Land Management move. A lot of people will say they won't go. You've heard that he's wanting to turn all the senior policy level people at the various agencies into what he called Schedule F, which simply means he can fire them. Right now, it's pretty hard to fire a government employee. It's a very difficult, long process. There will, I'm sure, be some kind of budget cut at EPA. You know that he's out there with the idea of resign now, and we'll pay you till September. The courts are still ruling on that, but obviously there are already people at EPA who have said, yes, I'm willing to do that. And then I think last but not least, you got the idea that if you remember in the first Trump administration, he said whatever agency wants to implement a new reg, that's fine, but you got to do away with 2 regs at the same time. This time he's got the same premise, except instead of doing away with 2 regs, he wants you to do away with 10. So it takes just as much work to get rid of a regulation as it does to implement a new one. So if I think about that, and you think about what we're going to do in terms of there, we already have an increasingly difficult time, harder to get new pesticides through, a whole lot more money to get a new pesticide through, and you throw all these new things in here, and what I want you to think about is, it's an unintended consequence. I guarantee you, the president or probably anybody in his administration has never thought about this before. But there will be, from some of the things he's doing, unintended consequences. And that's where I think you have to come in and you have to be very vigilant about watching this and making sure that we get that input back to members of Congress, to the administration about, hey, slow down, we need an exemption here, we need an exemption here, let's think about it. But it won't just happen to this particular agency. I just threw it up as a good example, I think. I think there's also lots of things, indeed, that can change the president's mind on how fast he moves forward, if he continues to target a certain area or not. Certainly, congressional engagement and advocacy is one of them. I kind of chuckle. If you call into your Senate or your House office building, there's a Senate switchboard, so the call goes into the switchboard and then it gets divvied out to the 100 senators. The same thing over on the House side. And Senator Murkowski from Alaska said the other day that on average, there are 40 calls into the Senate switchboard every minute. But for the last couple of weeks, there's been 1,600 calls per minute. People are saying, what about this? How is this going to impact me? You know, I'm concerned about it. I want to share with you my input. So I think very, 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 very key. I was also up on the Hill on Thursday and had a congressional staffer say to me, before he left on Friday, he had 2,500 voicemails he had to listen to that had been left on that congressman's voicemail that he had to say who called, what did they want, tag them all so they could get back to those people. I mean, there's a lot of input coming into Congress right now. Some of it very supportive, some of it kind of questioning. So if I go out and speak for the last, I don't know, 6-8 weeks at least, the question I get most asked about is, what about RFK? Are we going to survive RFK? How does it go? And I think the thing that's important to remember about RFK is everybody who comes in and decides to serve in a cabinet level has to salute to the president. That's always true. It's even more true this year. He has loaded that cabinet full of really loyal people. And so, yes, we want to impact RFK, but who we really want to impact is the president. I think a big part of that in agriculture is indeed going to get done through Brooke Rollins, who hopefully in the next couple of days gets confirmed as Secretary of Agriculture. We're going to have to use her. We're going to have to use Lee Zeldin down at EPA. We're going to have to go to those folks and make sure, indeed, they're the last one in there talking to the president, not RFK. But I think, indeed, that can happen. And again, RFK is important. He makes me nervous, too, yes. But really, I think we have to rely on getting to the president every time instead of worrying a bit too much about him. Now, I also want to throw this up, and I thought the Wall Street Journal did a great job here. I want to, we all know it's not our grandfather's Congress, it's not even our father's Congress for that matter, but went back to when Trump was elected in January of 2017, and you can see the blue Democrat, the red Republican, and then you can see kind of a mishmash of yellow dots for people who actually endorsed Trump and purple dots for those who didn't. So if you take a look at that chart and then you look at this one, which is this election, pretty big change. Everybody in Congress, everybody, I mean, 70% of Congress believes they owe their existence to President Trump, and therefore they are very loyal to him. I looked at numerous ads, especially that these are the 4 senators that kind of won out of the blue. We didn't really think it might happen. Almost every ad they put out either had a picture of Trump with them, Trump endorsed, et cetera. These people believe they owe their existence to him. So there is way, way, way more loyalty now to the president than there has ever been before. Leads me back to the idea of right now he is somewhat of a dictator. I mean, he holds the sledgehammer, and at this point, virtually everything he has talked about is going to happen. Another thing that's an interesting trend when you think about Washington is that we used to have a lot of split ticket voting, where you vote for a Democratic president, but you vote for a Republican congressman in your district, or you vote for a Republican president and a Democratic. And people said, I like keeping it mixed up. I like the checks and balances. Well, you can see that doesn't happen anymore. Very, very, very few split ticketing. In fact, only 3.5% of the 470 people that ran in November had a split ticket. So again, you think about the premise of how beholden many, many members of Congress are to the president. I already think Speaker Mike Johnson, without a shadow of a doubt, has the worst job in Washington. But think about it, he got elected again to serve as Speaker a few weeks ago, and within an hour of when he got elected, there was a letter from about 35 or 40 members of the House Freedom Caucus, so the very right-wing caucus, saying, hey, we just want you to know we only voted on you because of our support for Trump, et cetera. And then, by the way, we cast our votes despite our sincere reservations regarding the Speaker's track record over the past 15 months. Man, how's that? You're Speaker of the House, you got 220 members, and 40 of them say, you know, we don't really like you, buddy, and we only voted for you because of the president. So again, a little bit of a hold that's going on down there. Now, it will not always be total control. There is no question that President Trump really wanted Rick Scott from Florida, senator from Florida, to be the majority leader in the Senate. He got John Thune. John Thune was one of the last people to support him. I would tell you, I think John Thune is the greatest thing since sliced bread. I think he is the best thing that could have happened to agriculture. Having that kind of position, he's from South Dakota. He served on House and Senate Ag Committee the whole 25 years or whatever he's been around. I was at a function for him with, I'm going to tell you there were 100 people in the room, 100 people like me, but only 2 Aggies. Everybody else was finance or healthcare or whatever, maybe about a month before the election. And I think people asked John Thune 8 questions after he gave a little presentation. And 7 of the 8 questions, he referenced agriculture in his response. It was about taxes, it was about trade, it was about immigration. But 7 out of 8 responses. I think that tells you just what a strong ally we have there, as well as people like the John Bozeman's of the world. But greatest thing that happened, Matt Gaetz' withdrawal was a little bit of a hit. I'll talk about the CR, but again, you had those House Freedom Caucus members that said, I'm not voting for the continuing resolution. So he is not going to win every fight, but in reality, for a while, he's going to win many fights. When you think about what's happening in Washington, you know it's a very narrow margin. Poor John Thune has a 53-47 Republican-Democratic margin, so he can only lose 3 votes on everything that comes up, or he's got to have Democratic votes to support it. You look at Mike Johnson, he's even worse. When it gets staffed back up, probably be 220 Republicans, 215 Democrats. So again, he can lose 2 votes before he has to have Democrats. If I was Mike Johnson and I was mad at the president about one thing, it would be that he took 3 of my people in the Republican members of Congress and he put them in his cabinet. And so he took the margin down from 220 to 215 to, as soon as we get Elise Stefanik, it'll be a 217 to 215 margin for quite a few months, meaning he cannot lose any Republican. 0. Now that isn't just, keep in mind, a Republican deciding to vote against him. It's a Republican who gets hit in a car accident and is in the hospital, or somebody who dies, or somebody who's got the flu and just can't come that day. It's 0 votes every day for the next couple of months. And probably after that, he'll get 2 of the 3 votes, but it's going to be a while. So it's going to be quite an interesting couple of years. Now, here's my watch out number 2. And it's a little bit, kind of maybe off message, but I think we all look at that map on the left and we see the red, and of course, we all know that, right? But I decided, we all know too, that the House Ag Committee now isn't exactly what it was 10 years ago or certainly 30 or 40 years ago. So when the US Ag Census gets redone, it's redone every 10 years, I went through and I looked at one of the things you can find is the number of farm producers per congressional district for all 435 districts, right? So in red are Republicans, in orange are Democrats. So in essence, the way to read this is, until I get to the 44th largest congressional district in terms of farm producers in that district, they're all Republicans. And there's 1 Democrat at 44. And by the way, they're not on the Ag Committee. And then I go all the way to 71 before I find another Democrat. And by the way, they're not on the Ag Committee either. And then I go to 110 before I find the third one, and they are on the Ag Committee, but they're from Hawaii. So it's not exactly agriculture like we all think about it here in Arkansas, right? Very, very different. These people are largely here because of the SNAP program, food stamps, women, infant, and children, the nutrition programs. That is not to say we don't have some great Democratic friends. I think Angie Craig will be a great ranking member from Minnesota. I think Nikki Budzinski from Illinois. I mean, there's several people that care about agriculture. I'm just trying to share with you, really, when you think about their districts, how few farmers and farm producers actually happen there. So it's very Republican. For me, I would tell you, it probably doesn't affect too much of what I'm doing in the Farm Bill, although I would say it's going to be a flip when I think about SNAP and being able to write a safety net. But if you think about somebody going to EPA and saying, we want, especially when there was a Democratic president, I want EPA to change this. Well, no matter what the issue is, I could probably go to the Hill, and in a week I could get 10 or 15 Republicans that would say, I'll sign a letter that says, hey, you guys got to rethink this, right? But when Republicans send it to a Democratic administration, it might last past the first trash can, and it might not. So what do you need? You need some Democrats, especially Democrats that are in tough races. Well, if I have to go to the 41st Democrat or the 70th or whatever it is, there are only so many times that agriculture can go to those Democrats and ask for favors because they're going to say, we did you one, we're on somebody else now, et cetera. So it does make a difference as we think about ag policy. I think we've had several thoughts this morning about all the things that are going on in Washington, lots and lots of financial issues that are going to have to be dealt with. So you remember we passed the continuing resolution the 21st of December. It kicked the can down the road on all those 12 appropriations bills that weren't done that started funding the government last October 1st. That's going to expire in another month. It's coming right up at us. We have already exceeded the national debt limit, but through different ways, they play some different money games, and they can stretch that out till June, July, somewhere in there before we really hit that debt limit. Then we have to do something. Come October 1st, we got 12 more appropriations bills we should have done. And that last but absolutely not least is there was a massive 2017 tax package that Mr. Trump got through then, and the vast majority of those provisions are going to expire at the end of this year. So we have to do something about those tax cuts. And we're doing it all against a rising deficit, a rising debt, et cetera. So, whoops, there we go. So you hear a lot of discussion, you probably hear a little bit more today, about reconciliation bills, the budget bills, et cetera. And so you hear Trump and Mike Johnson talk about one big, beautiful bill, and you hear John Thune say, oh, we probably have to do 2. As of a couple hours ago, it looks like the House has finally said, yeah, okay, 2. But so the idea is the first bill would deal with government spending. We've got to kick the can down the road. We've got to figure out how to fund the government till the rest of the fiscal year. We got to do a good energy policy, and then we got to do something about the border and deporting illegal immigrants, et cetera. And then what the House really wanted to do was put the tax extension bill in there too, and that's just probably not going to happen right now. But those are the big 4 issues that will happen. And the really only important thing about a reconciliation bill, because it's inside Washington politics, is for a normal bill in the Senate, you have to have 60 yeses to pass something. So if John Thune has 53 Republicans, he got to go find 7 Democrats. So it forces people to come to the middle and get something done. Under a reconciliation bill, you only have to have 50 senators that vote for it. So if, big if, but if John Thune can keep at least 50 of his 53 Republican senators in line. And if Speaker Johnson can keep all of his Republicans in line, you could pass a reconciliation bill that deals with these 3 or 4 things with only Republican votes and not have to ask for the Democrats' opinions. That's why there's such a big push on trying to get this done. Now, I think one of the most unanswered questions in Washington is, does Congress really care about the deficit or not? I would tell you, I don't know what it was. 25 years ago, Charlie Cruz, we used to talk all the time about Farm Bureau, about do something about the debt, the deficit's terrible, we got to get it. But you know, for 20 years, I've heard hardly anybody talk about it, right? Until maybe 8 months, a year ago, et cetera. And now you're getting some members of Congress that are saying, we got to do something. This thing is out of control, we got to move. What I would ask is, when you look at this outlook, do they care enough to do something? And I think it's going to harken back, this is just my 2 cents, but I think it will harken back to the idea that President Trump did not run on I want to cut the deficit or I want to cut the debt. He ran on I want to extend the tax cuts from 2017 and I want to make sure some other tax cuts happen. And I don't think you can increase the tax cuts and extend the tax cuts and do something about the deficit. But there's going to be a lot of pushback. So my next watch out is sort of what I call funny money, just something interesting for you to watch. But if you look at the tax bill, you can see the blue there. Just to extend the 2017 tax bill is $4.6 trillion with a T over 10 years, so not cheap. Then you look at, okay, other things that the president said he wants, extending the, taxing tips, not taxing Social Security, et cetera. You can run that number to 10 trillion pretty darn fast. So what he said, pretty much nonstop, is I want to raise tariffs. And then I think I can use the income from the tariffs and I can pay for the tax bills. So one of the things that is being talked about all the time is using this crazy term called current policy, so that instead of, even if we just did the 4.6 trillion in tax cuts, saying it's current money, meaning it really wouldn't cost anything. It wouldn't get scored out for Congress that doing the tax bill cost anything. Now, is it still going to raise the deficit? Absolutely. It's funny money. But it's a way of saying they want to move forward to do that. The other thing is taking these tariffs and then trying to impose them and use those money. Well, if you really look at the rules of the House and Senate, it would have to be the House and Senate that passed the tariff to use the savings to then be spent on taxes. So if we have Trump, who's already come out and said, okay, I'm going to do 10% on China and I'm 25% on steel and aluminum, et cetera, in reality, he did it. It will have an impact on the deficit, but it can't really be used by Congress to say, this is our savings, we're going to use it over here. So I think our big question is, how much funny money, especially do the right-wing Republicans, let him buy with? No question, and I can't remember now who put this up, maybe Dan, about how much money we used to get out of tariffs. We get practically none now, it's like 2%. But again, when you think about how many different things in the tax cuts that have to be paid for, it is a ton of money. And I would tell you, every good lobbyist would come out and tell you, if you're not at the table, you'll be on the menu. But I would say, especially with the tax bill, don't forget about it. Don't not focus it on, because you will indeed be on the menu. There are so many groups that have hired so many people to come in and lobby for the one thing they want in the tax bill. So we may say, oh, they wouldn't take away the doubling of the state taxes, or oh, they wouldn't take up stepped-up basis, et cetera. We all got to be there, and we got to be there in a big way on taxes. So I know the Farm Bill is up there in terms of interest, as is immigration, but taxes is something to really watch out for. Tariffs, I don't think we know much. I mean, we know he did implement them on China, and they have now come back with some retaliation. He's going to do it on steel and aluminum, presumably. I strongly suspect retaliation there. Mexico and Canada, he put the decision off for 30 days. So, when I talk to farmers, I think almost to a T, every farmer says, say, what do you think about the tariffs? Well, I think he's a great negotiator. I got to believe he knows what he's doing, and I'm willing to trust him. But I am nervous. I think that's pretty much the viewpoint. And so it's yet to be seen, what kind of retaliation do we get? Do we get nothing? Certainly when he went to Colombia and he said, if you're not letting my planes fly in with the immigrants, then I'm going to put a tariff on you. They turned around in a heartbeat. Mexico and Canada came to the table long before he actually did it. And, now we're in another month. We still have to figure out, is he going to follow through? Or are they going to offer enough, et cetera? But tariffs will continue to be a big deal. You think about where we are, no surprise, but China, Mexico, and Canada are our biggest 3 customers, and it's essentially 50% of where we send our exports. So very concerned for what happens to agriculture. We all remember back to 2018 when we had the tit-for-tat China trade war, and unfortunately it came back on soybeans in a big way. So we sure hope that this time it goes elsewhere than ag commodities if indeed there are retaliation. I have great congratulations to the soybean and corn folks who put together a study about potential impacts of tariffs and what if, for example, we would go in and we would tariff China at the 60% the president suggested. What if they retaliated? It's $1 hit in the price of corn, or 13 cents hit on the price of corn and $1 a bushel hit on soybeans. But I think even more importantly is, you know, you've already seen we're losing our lunch to the Brazilians. We never have recovered from 2018. I don't think we ever will. And if we did something like this, I think they take even more market share faster than what Dan talked about this morning. Dan and John have both talked about this, but pretty big increase there. 2 watch-outs I want to give you. One is that almost every farmer I talk to says, well, you know what, Mary Kay, if there's a tariff, Trump will make us whole. He'll go back in the USDA and he'll just pay us the $23 or $25 billion that he did before. So this little slush fund at USDA called the Commodity Credit Corporation doesn't have that money right now. It's only got $4 billion in it. So that's not to say that somewhere the president won't come up with money. It's not to say necessarily that Congress won't give us that money, although I think that's a lot iffier than the president doing it. But I wouldn't just sit back in my chair and say, well, if it happens, I'm going to get reimbursed, because I'm not sure at all that that indeed happens. And the second thing I would point out is that, you know, you look at the amount of ad hoc assistance that's gone out there. It makes me incredibly nervous for the crop insurance program. For years, we have been able to go to the Hill and say, look, keep the crop insurance program, make it stronger. Farmers have skin in the game. Yeah, they don't pay the whole 100% of the premium, but they do. It's important. It puts out money quickly. We don't have to wait for disaster. But at some point, there's going to be people who will say, why are we paying subsidies for the crop insurance program if we're just going to keep popping out ad hoc disaster assistance? I think that's coming, unfortunately, sooner instead of later. Now, you've seen this chart at least twice this morning. I give you just a bit of a different flip on it in that, first of all, you can see that the increase that they're now projecting for 25 is all made up from this $42 billion that will come out presumably in 2025. It includes the $10 billion John talked about and the $21 billion for disaster. So it's going to hit. I think when you go to the Hill, this is the most used chart there is. Not by me, probably not by Farm Bureau or soy or rice or whoever it is, but by our opponents, because they take this chart and they go, hey, look at this. If you put a trend line across the middle of that, what you're going to see is in 2025, if the number's right, we're 45% above a 20-year average. And members of Congress who don't have agriculture in their district or think we have had enough are going to say, 45%, I got a lot of people that could use the money more than agriculture. I think, unfortunately, while it's good news for us, it's going to politically cause us a lot of hassle. You also saw something very similar to this, but if I could say one message that I think is really key for farmers to talk to their members of Congress about, it is to say you can't take averages like this. You have to look at the differences. And you heard this from both Dan and John, but we ought to be talking about, and we ought to have pictures like this, more than just this. We need way more, but we need those members of Congress to understand that just because the average may look pretty good, it looks a lot better for the livestock sector than it does for the crop sector. And in general, it's the crop sector that relies primarily on the Farm Bill. We got to get this message across, and we haven't done as well yet as we should. We did well enough to get that $10 billion, but you know what? We didn't have a Farm Bill in 23, we didn't have one in 24. If you ask me my bet today, I bet we don't have one in 25 either. We got to do better about telling this message. Then I have to tell you, I really thought about whether I should put this slide in here, because I don't like people throwing tomatoes at me, but I think it's really something that made me stop and think several times. So mid-December, one of the farm publications, I don't remember if it was Farm Journal, Progressive Farmer, somebody did a survey, and they surveyed 2,500 farmers, and what they said was, should Congress approve economic aid for farmers before the end of the year? And 71% said yes, 29% said no. So the headlines came out, 71% of farmers say we should do economic assistance this year. And I thought, wow, the headline to me is, who are the 29%? That's amazing, 29%. So first I thought about, well, you know, specialty crop growers, they're not going to get much out of this $10 billion. And then I thought about livestock, so I thought, well, there's some. And then I thought, yeah, but I wonder about the rest of it. So I went out to 4 or 5 of our sales reps that meet with farmers all the time, and I said, hey, do me a favor. You know, when you see your folks this next couple of weeks, ask them what they think about this. And ask them, who do they think the 29% are? And overwhelmingly, it came back, hey, we need to quit shoving this money out because it's causing land rents to be higher, it's causing poorer farmers to stay in business versus somebody good like me, et cetera. So the reason I think it's important to share this is, you know, if you're a member of corn or soy or wheat or farmers union or whatever, you know that your organization is in Washington fighting 110% of the time, we need help, we need help, we need help. But what you also ought to know is 29% of the people out here in the country who are visiting with their members of Congress are saying, we don't need that stuff. Get it out of here. It's having negative impacts. So we think about agriculture as a whole and being very much together on this issue. I don't think we are anymore. I think it's a real change in the way things are happening. So on the Farm Bill, the reason I think it's going to be very, very difficult, the vast majority of it, as you know, is nutrition programs, primarily SNAP. When the House Ag Committee passed their Farm Bill last July or whatever it was, they took $20 billion cut in SNAP. I don't know, I think there were 25 Democrats on the committee. I think 4 Democrats voted for the Farm Bill, right? The rest of them said $20 billion cut in SNAP is too much. So we talked about this budget resolution, the reconciliation package is going today. The Senate Budget Committee is starting markup of theirs, and they're going to ask the Agriculture Committees to come up with $100 billion in savings. Now, it doesn't have to come out of SNAP. It could come out of crop insurance or conservation or rural development, but when a big part of the budget is food stamps, you know that's where it's going to come from, right? And it just came out within the last hour that the House Budget Committee is going to start tomorrow, and they're going to ask the Ag Committee to come up with $230 billion of cuts. $230 billion. I mean, it makes $20 billion look like peanuts, right? So then I question, well, if they come up with those cuts in SNAP and it really passes, can we do a Farm Bill in a few months and go back to SNAP and say we want more funding? I don't think so. I think if they already gave that kind of money, anywhere near that kind of money, they're going to say, no way, we gave it the office. Go get agriculture. Last year, they wanted to save $13 billion by clawing back the stuff at conservation that was targeted from inflation reduction and said, you can do conservation measures, but it's got to have an impact on climate change or it can't come. There's not $13 billion left anymore. There might be 8 or 9. There was a big push wanting to not let the Secretary of Agriculture have this slush fund at USDA that was used to fund the climate smart agriculture. That's pretty easy to do when you have a Republican House pointing at a Democratic president. Do I think a Republican House or a Republican Senate wants to point at Brooke Rollins and say, we're taking away your authority? I don't think so. So I think there's anywhere between 8 and 50 billion, but at least $8 billion. When the House Ag Committee bill passed, it was already $25 billion short. So to pass a new farm bill that really has an adequate safety net, we got a lot of money we got to find before that happens. And one of the concerns I have, and again, one of the reasons I think we have to tell this story about, yep, livestock is generally doing okay, row crops are generally not doing okay, is this is my 9th farm bill. I've seen it every time, no matter how much a lobbyist or a member of Congress or a staff person in Congress tells themselves, we write a farm bill, we generally write it for 5 years, we tell ourselves, hey, whatever economic circumstance we're in today is going to be the same 5 years from now. We still write it like the circumstances today. So my concern is if we have people looking at that high farm income level, that 180 billion, and not really thinking through, not understanding how it affects us, we could have people say, farmers are doing really well, we don't need to really give them much of a safety net because they're 45% above the 20-year average. It is going to be a hard issue to push. So maybe we get a farm bill. I can tell you, I saw something Steve Scalise, the number 2 guy in the House, put out a week or 2 ago about here's my issues. He had 13 issues he wanted to deal with this year. The farm bill wasn't on that list. It was not on that list. Immigration, we all know what a problem we have and what a problem the H-2A labor rates are and everything happening there. I thought it was quite interesting. I was at the American Farm Bureau meeting a couple weeks ago. Did we talk about trade? Did we talk about tariffs? Did we talk about, yep. But the one issue I heard way, way, way more about in the hallways than any other issue was immigration and farm labor. And what are we going to do? I've never seen that before. I've seen an increasing trend when you go to farm groups about thinking about those things, but I've never seen it be the #1 issue. So what happens with immigration? Where do we go? You know, we look at wages for H-2A workers. How does somebody in California that's paying their worker $20 an hour compete with Mexico and some of the Canadian provinces? I do think there's some good news. And I think that is that we look at, so the numbers on the left are red are Trump 45, the blue are Biden. So it's the average number of people, immigrants, illegals, who are arrested every day. You can see not a whole lot of change. But if I take that big number in 2023, that 467,000, and I multiply it by 6, it would still take 30 years to deport all the illegal immigrants in this country, unless we get a ton more money through some of these bills, but 30 years. So my premise is, first they're going to go for the people with a record, rightly so. Then they're going to go, I think Trump will go for as many numbers as he's going to get. And if I was him and I wanted numbers, I'd go to inner city Detroit and Chicago and LA, not out to some farm in the middle of Arkansas and look for 4 or 5 people. So I think if there's good news on immigration, I have to bet that we won't get hit right away. I think there is good news. I think Brooke Rollins will stand up. You know, by all accounts, she's the closest cabinet member to the president. So I think that will play really well for agriculture. I think farmers supported Trump, and he won't forget it. And so that's going to play well in our favor. We will indeed, I believe, have fewer regulations. Think about things like waters of the US, et cetera. So that ought to be helpful. If I was picking a winner and a loser, I'd say large farms are going to benefit and small farms are going to lose in this administration. I don't think there's going to be near the viewpoint on consolidation and some of those things. More emphasis on renewable fuels. Do they have the answers? No, but certainly want to go there. Deportation won't get it. And of course, I think the good news is I got job security forever. So there's going to be some things that probably aren't going to be good. I continue to be very, very worried about tariffs and what happens to us. But certainly there's going to be some good things happen in the next 4 years. So I put this back up here. I think these are the issues that for me come most to mind in what we're likely to deal with in the next few years. But I cannot overemphasize the need to just don't stay home and fret about it. Make sure you go to a town hall meeting. Make sure you come with your group to Washington and visit with these members of Congress, because there are so many people vying for folks' attention, and they aren't necessarily people that are going to be helpful to agriculture in the future. So I don't think there's ever been a time when it's more important that we make our voices heard than it is right now. So with that, I know we're going to do some questions, and I can't tell you that I can tell you that I agree with 110% of what both Dan and John said, and I think they said it much better than I, but I hope that from seeing some of the same charts 3 times, maybe there's a political angle on this that will help you as you decide to move forward and be more active. And it's not just federal stuff too, there's a lot of important state stuff going on, but certainly our plate is full. You know, not to take anything away, John, from having that thing up here about farm stress. Could you make one for me for Washington, D.C. stress, John? Because I think we need it out there too. It's an interesting world to keep up with right now. But Bert, appreciate the opportunity.
Okay. You can just hang here. Well, thank you very much, Mary Kay.
You didn't hear me say
A lot
I
of good
asked if you would
information
make a
there.
little thing
We
that
are going to
wasn't
roll
a
into our
stress.
discussion panel. We have some setup to do, and so I invite Dan Basse, John Anderson, and Mary Kay to stay and join us here on the stage on the discussion panel. And I'm also inviting, Matuschka is occupied, she won't be joining us, and so I've asked our longtime friend and supporter of this event, Greg Cole, CEO of AgHeritage Farm Credit, to join in. Those of you who don't know Greg has over 40 years of experience in the farm credit system and began as a student intern with the Farm Credit Bank of St. Louis. Greg's an A-State College of Agriculture alumnus, also a graduate of the LSU Banking School. So bear with us as we set up our microphones. Once you're ready, you can take a seat. until we adjourn for the noon luncheon. And just to give you some announcements, this year, as last year, we will be having the luncheon across the parking lot in the Embassy Suites Red Wolf Convention Center in the Embassy Suites ballroom. So looking forward to that. Okay, so we will take discussions from the audience. You're welcome to, and also they'll bring up the house lights in a minute. No, we're 4 is all. Okay, so Greg Cole, I put you on short notice to join us today. And Ag Heritage Farm Credit, farmer-owned cooperative, agricultural institution working directly with farmer members. You've heard the discussion this morning, not new to you. How are your members, what's the mood of the membership? What are their concerns and how are they adjusting to current conditions?
Yeah, that's the last time I'm gonna read my email Sunday morning. But Bert, obviously, we've seen better times. I know since I walked off this campus 41 years ago to loan money in the Delta, I've seen a lot better years, and I think the speakers have depicted the gravity of our situation. I would describe it this way. Most of the farmers obviously are very concerned. A lot of anxiety given the gravity of our situation, especially in the crop sector here in this region of the country, the Mississippi Delta there. Which leads to procrastination. I know they're later coming in to see their lender, whether it's us or community bank or whoever their primary lender is. So we see that is, and farmers and ag lenders, we're used to cycles. So we've been through these, whatever. But I think the group this morning really depicted, and I told John he stole mine when I was in Texas last week when our old friend Joe Outlaw, his prediction of 42 years, and I go, well, there it is. The first time, this one is troublesome. It is different. People, I'm probably one of the few P80s, product of the 80s, still loaning money now, Bert. And we're saying well, this is not the 80s, but we see some resemblance to that. We haven't seen some things. So that's how I would depict a little bit of where we're at, just to break you down and give you some little, I call boots on the ground from more of the academic analysis is here. I lead one of the 3 associations here in Arkansas, Ag Heritage. We're in 24 counties, central, southeast. We're about $4 billion in gross loan assets. When we look at our numbers, our operating loan, and we're in the operating loan season right now, when you break down as we come into even 24, of all of our operating loans, the ones that have operating loans, you go back to 22, roughly 40% of our customers had negative gains, in other words, lost money. And then you go back to 23, when you look, probably about 50% when you look at a lot had held inventory and wrote it down. So they went into 24 already in a pretty tough situation, adding a lot of carryover debt. And then we're halfway through our loan season and talking to our credit department, and there's some of them here, a lot of them here today. We're looking at so far 75% of our customers have lost money, and 25. And those losses could be on an average of about $136 an acre with a severe of 400. There are some positives doing that. So when you put all that together, it really is a compounding effect, and as unfortunately y'all laid out, 25 doesn't look better. And when you really break it down, we had strong to record yields last year. So if you just pencil in average yields at these prices, and the input prices are so sticky here, we could very well have a loss at the end of the year. So for some people, there will be a 1-year loss. Some, this could be a 4-year loss. And here's the challenge. When you add all these losses in from an ag lending standpoint, at these elevated rates, or I should say more normal rates, all you do is exacerbate the situation. We always say in ag lending, a farmer can't borrow the way out of a problem. So all this stuff is compounding. I was just at a national meeting, Farm Credit, last week. There's other areas of pressure, but I would say this Mississippi Delta has some of the most extreme pressure right now on things. So anyway, put it in perspective. We are doing loan structures and non-traditional and creative loan structures that I haven't done since I saw my old boss here, Paul Hall, that was my mentor and stuff when I worked for him in our Brinkley office back in '85. We're doing some things now I haven't done since then. So, we're a mission driven. We've been around for 100 years. Our mission is to serve agriculture in good times and not so good times. We will continue to do that, but we'll always tell people, mass and the numbers are numbers. If I make a loan and I lose money, it comes out of the member's equity or package. So we're really working through that. Bert, the adjustments is this. People are having to curtail non-income producing expenses, sell in non-income producing assets, curtail capital purchase, renegotiate land rents and all that. So, but we're loaning against collateral. The balance sheet is eroding through operating losses and equipment depreciation. At least we don't see the negative trifecta that we saw in the 80s of land. But if we start seeing more land to go on the market to sell, to pay down debt or get out, that could exacerbate. So the summary is this: without a major government intervention or a shock to the market here, we're in a very dire situation here in the Mid-South. So I really want to say, I know our group, a lot of folks here have worked on it, but here's my ask. We need this payment of $10 billion, and that's been committed for, but not in the office of FSA now. We need to get that money. We need another one of those. We need to get the Farm Bill passed at a more elevated or enhanced reference price, have it retroactive back to at least 25, and then stair step into inflation going forward so we were not into this. So sum it up is Jeffrey James, here a lot of you know her, she's one of our customers from Newport. She did an excellent job in testifying in the Senate Ag in DC a couple weeks ago, and to quote her is, farmers are down to their strategy is a hope. Hope's not a strategy, and that's the same thing for ag lenders. But here's what I would say the positive is. Been doing this for, when things are so bad, here's the thing. Life in business has 3 cycles. You're either in a problem, going into a problem, or coming out of the problem. We're in a problem, so we're going to come out of it. The question is when and how much damage.
Well, thank you, Greg, for your perspective with his pulse on the agricultural lending part of our industry. So we're going to open this up for questions and discussions. We have about 15 minutes here. Ted Glob, you always have a question ready for me. I'll take yours if you're ready.
Well, one of my questions on the Farm Bill, and I've been around for over 40 years, it seems like the ag industry is easy to take the hits. Inflation is increasing our cost. Government restrictions on availability of funds has reduced our subsidies and various programs that I'm beginning to wonder if we're not entering into the point that our support programs are not at a level that work, not at a level that can be passed in DC because we're too small of a population anymore. And boy, this one would be shocked. Maybe we need to get rid of the darn thing. Because I know one operator in Texas that basically told the government to shove it, and he's fairly profitable.
So the question or the comments have to do with the relevance of farm programs in the future. Mary Kay, I think you mentioned the likelihood or lack of actually having a farm bill passed in 2025. And if that's the case, what's the implications for this adjustment process that has been alluded to here this morning? Who'd like to jump in on that? Mary Kay, are farm programs increasingly irrelevant to U.S. agriculture?
Well, certainly I think where the reference prices are now, they're not being very helpful. So I wouldn't call it hopeless. I mean, I give you my best shot. I can tell you, we're going to get a farm bill in a month, but it really wouldn't be what I believe. So I try to share with you what I think my perspective is, and I think it's an uphill climb. But you know what? So was that $10 billion that agriculture got 4 days before Christmas. I mean, if I'd asked anybody in this room a month ahead of that, could we do that? I think everybody would have said, oh my gosh, no. But farmers rallied. And, I would tell you, too, one of the best things that happened is the farm credit system and the banks went along and said, without this kind of stuff, we're not going to be able to lend. And For whatever reason it is, Congress believes the bankers more than they believe the agricultural industry. But, so they're extremely helpful that happens. But I think a campaign can be mounted. I just think it's going to take a tremendous amount of work and focus from people like you.
So Mary Kay, I would ask you, if we don't get a farm bill in 25 and we're going into a midterm in 26, what's the chance we kick the can for 2 years?
Oh, gosh. You know, I'm afraid if we kick it past 26, we'll never get another farm bill.
Well, that's the next question I was going to ask.
yeah.
There's some people out there saying we may never write another farm bill.
Yeah, I mean, it's going to be tough. I guess I'm in hopes, Dan, that we deal with so many of these financial problems in 2025.
Yeah.
We finish the tax bill, you know, we do these things that in 2026 we can come back and focus again. But
Yeah.
I just don't see how we do all these financial things that have to be done this year and find more money for a farm bill.
No, I hear you. I just wanted to bring it up so we talk about it.
Okay, any other thoughts on that, or?
Yeah, I would just add
John?
real quickly, I mean, this is a conversation that's come up over the years. I mean, to Mr. Glob's point, right now, the programs aren't operative. I mean, the money is not there at an effective rate to be a safety net. The question of, you know, should we have it, should we not have it? That's a fair conversation to have. It's a conversation we've had many times. I would point out, how many of you remember the 96 Farm Bill? What do we call the 96 Farm Bill?
Freedom to farm.
Freedom to farm. I referenced direct payments in the 2002 Farm Bill in my talk. Those were a continuation of a payment that was in the 96 Farm Bill. What was that called? We call them AMPTA payments.
Transition
Because
Act
they were
payments.
transition payments
Yep.
away from farm program payments. We've made starts at transitioning out of the Farm Bill before, and it's never stuck. I question whether the political will is there to not have a Farm Bill of some kind. I think when we have talked about doing away with the Farm Bill or not having these programs at some level in the past, we have not been willing to bear the pain of adjustment and transition. Maybe things are different now. I think it is telling that, to Mary Kay's point about the survey, you have people in the middle of what is a really tough time talking about, hey, maybe this is not helping, we do something else. Typically, when we've had these conversations, it's been when things have been pretty good and the programs have kind of gotten in the way of what we wanted to do. So I think it's an interesting perspective. I'm not convinced that the political will to completely do away with the Farm Bill will happen in my lifetime, but it's not a new conversation, certainly.
But I do think there's more and more conversation going on about maybe commodity payments are irrelevant, and maybe we should move that funding into crop insurance, make crop insurance stronger, and forget
Yep.
about
Agreed.
payments.
Okay, next question from the audience. Do I have one? Yes, sir. Mr. Bristow.
I'll address this to Dan, but last fall I read a DTN Progressive Farmer article that talked about the insanity of borrowing 7 or 8% interest to buy farmland that produces maybe 2%. And yet, it appears that farmland prices aren't really going down very much, if at all. And some people think, well, it's Wall Street or Bill Gates or foreign money. What is keeping farmland prices so high?
I would think it's a little of all of that. I think it's cash. If you notice that a lot of farmland is paid for already. I think University of Iowa State indicated that maybe as much as 68% of farmland is not carrying debt. So if you don't have debt, there's ability to hold it longer. And there is new money sources. I mean, I have more and more meetings with hedge funds and others out of New York talking about agriculture. They see a future in which it's autonomous tractors and different technologies coming forward. So this is part of the drive of the future. And, you know, I do think yields keep rising. I don't think we've reached a yield plateau yet. So you all, that field comes up, that 80 next to you, and you got to have it for a generational purpose. That's part of the discussion. I'm not sure it's one final thing, other than it's these combination of things that are really supporting the land market. And thanks for Cole here, because if we didn't have the land market where it is, we'd all be in a lot more difficulty. But for today, it's supported, and I seeing some of the classes of lower level land, you know, are starting to sink a little bit, but Class A land in Illinois, where I'm from, is still holding relatively strong. So we'll see what happens. but I haven't seen it where we have an auction yet and there's still no bids. When you see that happening, then we start to have some real issues. I haven't seen any of that. Maybe my colleagues have here, but you know, today there's still many buyers for the real estate that's out there. I don't know if my rest of my colleagues got any other points, but that's what I see.
You hit it.
Okay.
Another question from the audience? So I'll follow up on that one. So if the land value remains firm, okay, that's fine, but operators in the cost price squeeze that was mentioned can only afford to pay a certain dollar amount of rent and still reward all of the other factors of production, including labor and management, to stay in business over the long term. So are we, regardless of the land value, are we faced with having to drive the rent down, which just means the landowners are going to accept a lower rate of return on that high-priced land? The capitalization rate's going to change. Greg?
Yeah, good point, Bert. And when you had mentioned that, that was going through my mind. And Jennifer and I were talking about that. And there's a lot of renegotiating of rent here in eastern Arkansas, and rightfully so. But as you bring that down, you bring the cap rate down there, and then as rates stay, more elevated there, and you have more supply come on through the adversity, and we can expect that, I think, intuitively to do that. There's where you could have a downward pressure. Now, the shocks, who knows? I lived through a 60% correction. I don't see anything like that, but I could see us going through, if this thing, as projected, happens, we could go through a at least soft correction here in the delta for all those factors. Because when you lower that rent, you're lowering the cap rate. And so you would deter more buyers. And then we've got a lot of other folks here that's, in the real estate business, they're more probably astute to that. But I think what we talk about in our group, we've got the negative, I call the daily double. Our figure is when land values, if they don't start going down, then that really erodes the balance sheet. So that's the one in the 80s, yep. Jeff, and people that went through that. I lived through that when you were in the 80s. You would loan on a farm, and before the appraisal ink dry, it was down 20%. That is a problem.
Yeah. Absolutely great.
Anyone else on that? So you mentioned that you're seeing the land rental conversations taking place now, and adjustments are being made. I noticed, John, the University of Arkansas, well, no, it was the Southern Agriculture Today publication, which the U of A Division of Agriculture participates in, did a rental analysis calculation, and I believe this was for rice, showing the contributions of the operator and the landowner worked out to about a 20% share for the landowner, which traditionally, had been, I guess, the 25% would have been the standard share for that sort of land in the past. How rapid is this adjustment going to take place? Greg, I'm hearing it for the 25 growing season.
Well, we talk about in our group all the time. I lived in Starter for 20 years and managed there. My wife's got a farm there, and that prairie is mostly 75-25. But we've seen the migration, more to a 20%. When you get up around wind and up through there, they pay the fertilizer. There's different deals. But it is coming down, but it is sticky too, because it's the poker game between the tenant and the landlord, because all of a sudden, you want to renegotiate it down, they may come down after they done been turned down from another tenant that wouldn't pay it. So that game is being played. That's very delicate. We finance both sides, landlords and tenants. But overall, capitalistic economics work. It will eventually migrate down to a level, because we could see some marginal land not being farmed this year or next year. I mean, because the other part of what a farmer's doing, they're looking at certain land that's not as productive, and they'll let it go. And it's like our good farmer said, he offered 1,000 acres. I'm already penciling in a 200 loss for 25. Why would I want 1,000 more acres to lose more money?
When it becomes difficult to find an operator, that's when everything will change.
Well, I think there's some pockets in eastern Arkansas, we're starting to see that now.
Okay, let me wrap up with one thought. I go to Dan. If we think about long-term global agriculture here, Can you make a case that because of the new high-tech inputs, genetically engineered seed, the machinery and equipment, remote sensing, that the land itself may be making a smaller relative contribution to the package of factors of production than it did in times past? And what was traditional shares don't apply in the new world of high-tech, technology-intensive agriculture. Not to mention, Greg, some risk-bearing premium and the managerial sophistication that's required to manage in this market.
Yeah, this has been talked about for years, and I still see it in the cards. I think there'll come a day when some areas with big land tracts and operator availability that you could see landlords having to participate with the operator to get financing. Either co-sign notes, participate in something. I mean, I can see that. That's been talked about for 20 years, but I could see that at some point in time.
Dan, your thoughts on?
Well, as an economist, I always think of farming a little differently. Maybe we get to, this happened in Argentina in the last couple of years. Maybe farmers decide that maybe putting on fertilizer isn't a good economic return, and they can become profitable with some of those kind of things. But it changes the risk profile for revenue insurance and everything else. But again, I think as farmers, we got to think everything. But I also believe as a group of farmers, row crop farmers, we need to think about what could be the next demand driver that gets us out of this ditch. So I always tell farm groups, think about sustainable aviation fuel. They are serious. They want your crops. They want things that make their airlines fly. And they've had consumers checking little boxes. Do you want to contribute X number of dollars to a climate fund? Everybody may not agree on climate, but if someone wants to put up money, they got to spend it. So if we do have $30 billion gallons of additional SAF, sustainable aviation fuel, or even if we go to a E15 blend rate in the United States and we need 6 billion bushels of corn, not 4. These are things we need to plan for, but we need to get politicians behind it. And if we were going to drill, baby, drill, I want American farmers to be part of that drill equation. And so when I think about it, I don't think it's the world market we need to focus on. To me, it's about trying to position ourselves for additional demand domestically, because we are the high-cost producer that take us to a higher level. That's all I'll leave you with, Bert.
Well, thank you so much for that. That concludes our time for the panel. Let's give them a hand. So that concludes the morning general session. I'd like to invite everyone to make the trek across the parking lot to the back door of the Embassy Suites Convention Center. Our noon luncheon will be in the ballroom. Please make your way there now, and we'll reconvene for lunch.